Possiamo avere un attimo su di noi in streaming in maniera che introduciamo e poi passiamo sul relatore. Lucia, non so se sentono di là quello che stiamo dicendo, se riescono a darti su di noi in streaming in maniera che introduciamo e poi passiamo sul relatore. Ok, benvenuti. Welcome back to the second day of the Crypto Asset Lab conference from Milan, with the attendance in person and especially from remote, where most of the attendees are connecting from. The third Crypto Asset Lab conference is organized this year, as the previous one, by the University of Milano Bicocca, which is the host of the conference, the European Commission, the DG Joint Research Center, and the Digital Gold Institute. And I have to thank the sponsors that made this possible too. So CheckSig, Deloitte as gold sponsors, and Elidata, which is a silver sponsor. And we are ready to roll. And to start with a high note, we have a keynote speech from Professor Ricardo Pérez-Marco, Université de Paris. And he's been around crypto asset. It's a long time now, so quite an experienced speaker, and he will share his view on decentralized protocols. Marco, the stage is yours. Okay. Ricardo, the stage is yours.
Thank you very much, Ferdinando and the organizers. So it's a pleasure to be in this conference that is pluridisciplinary. So the main goal of the talk is just to make a thought on what are decentralized technologies. And so the first example is Bitcoin, and we have many things to learn from the Bitcoin protocol in order to develop future decentralized protocols that can do more than just a currency. So I will start by just recalling quickly how the Bitcoin protocol works. And well, I mean, you know, it's worth studying because Bitcoin, you know, is the author of Bitcoin, Satoshi Nakamoto, is an anonymous person or an anonymous group of people, but they did bring some very bright ideas. And indeed, the aim of Bitcoin is to be the first decentralized form of electronic money. Before Bitcoin, there were other decentralized forms of money. The historical gold, for example, is decentralized in the sense that it's valued in all civilizations and cultures. But what we need for our current times is a form of electronic money that is decentralized and not just relying on the banking system. And is based on what is the first decentralized consensus algorithm. So it's an algorithm that allows to reach honest conclusions and make honest decisions. Just if you only need to have a majority of the network that is honest. And in order to have a currency, we only need to have an agreement on what are the valid transactions. So this is done automatically in the Bitcoin network. And also one very interesting feature of Bitcoin is that it is the first decentralized currency that is programmable. So you can program the transactions. And this gives birth to more elaborate systems and decentralized finance. We had a talk yesterday about decentralized finance. Now, also from the physical point of view, is the first decentralized clock. Before Bitcoin, we didn't have a reliable decentralized clock that cannot be manipulated by an agency, a government, etc. You could take the NASA clock, right, in the NASA webpage, but this can be you know, tampered or manipulated by just the owner of the web page. Now, with Bitcoin, just counting the validated blocks, we get a clock. It's not a very precise clock. The average tick is of 10 minutes. But it's the first time, and I insist that this is a very fundamental feature of Bitcoin, that is the first decentralized clock you can rely on, and it's not manipulable. Now, it gives also, from the economic and financial point of view, a new financial asset class. This is something that is important to understand, because both for regulation and for economic theory, people have tried to fit Bitcoin into the set of currencies or the set of commodities. And this is one big problem, because none of these regulations do apply properly to Bitcoin. So people need to understand that this is a new asset class, and you need new regulations, new rules, and both on the regulation part, but also on the trading part and the financial part. And well, I mean, you know, I was saying this programmable feature gives birth to the decentralized finance that is, I believe is going to be the future in the next 10 years, where indeed all these smart contracts, what they do is they replicate classical financial instruments in a decentralized way. So you go overpass all the brokers, all the, you know, stock market structures, and you can trade directly with a smart contract, which is a very new feature. Now, let me just describe briefly the Bitcoin protocol and what we can learn from it. Is now 13 years old. There was first a white paper by Satoshi Nakamoto, this anonymous author, that was released in November 2008. So day by day, we are about exactly 13 years of existence of Bitcoin. And then he not only released this white paper, but he released the open code, and the network started to work on January 2009. Well, I mean, there was a wall structure that was also created by Satoshi Nakamoto. There was the Bitcoin Talk forum. If you want to learn more about Bitcoin history, you can just read all posts in this forum, where people discuss improvements of the protocol and bugs, etc. And you know, I think The Economist had a front page describing Bitcoin as the trust machine. This is quite accurate. This is already in 2016, because it's a trust machine that essentially you can summarize this as saying that it's a mathematical algorithm of trust and confidence. And so in order to reach a consensus. So the network essentially agrees on what are valid transactions. And this is a key feature. You want to avoid you know, double spends, so spending several times a Bitcoin. So the network has to reject this double spends. And it has to reject in such a way that it does not rely on the decision of a single entity or a single person, but it's a consensus. So how you build this consensus? Well, I mean, yeah, also made some sense, I like to describe Bitcoin as mathematical alchemy, because the model for Satoshi Nakamoto for Bitcoin is to create electronic gold. So it's the old dream of Newton and many people that tried to fabricate gold. Well, where the chemists have failed, the mathematicians have succeeded, and we have created, well, something that resembles digital gold, right? Now, if you think about digital gold, it's a good way of thinking because you understand some of the rules of the protocol that Satoshi implemented. Now, so essentially when you download the Bitcoin program and the Bitcoin source code and you can compile and you install in your computer, what it does first is to establish connections with existing nodes. So you create a network. So you have a network of computers where this small program is running, and they communicate between them. They communicate information about the transactions and the validated transactions and the transactions that are pending to validate. Now, each time you issue a transaction, the nodes check that this transaction is correctly signed, and they propagate through the network. If it's not correctly formatted or signed, they do not propagate it. So there are some basic rules that they have to respect. And once it's propagated, everybody has access to this transaction that is still not validated. So it has to wait that the network reaches a consensus, and this consensus is made by what is called a proof of work. There are nodes, not all of them. You can choose at the beginning, all of the nodes were mining, that not only they check this transaction, but they try to validate a block. So what is a block? It's just a set of transactions or these transactions that are floating around. They take some of them. There's a limit on the size of the block, and so you fit as many as you can. And then you try to validate by some process that consists in essentially computing power. the more computing power you have, the more chances you have to validate a block. And there is a competition between miners to validate these blocks because they get rewards for each block that they validate. Now, this reward, this is the origin of Bitcoin minting. So you create this Bitcoin by validating blocks. And at the beginning, you were getting 50 Bitcoins for each block that a miner validates. And the protocol adjusts so that we do have a validated block in average every 10 minutes. So it depends on the computational power of the network. So if the computational power of the network goes down, the difficulty for solving this problem goes down so that the average time is still 10 minutes. If it goes up, the difficulty goes up. And so it regulates itself every 2 weeks. It sets a new difficulty. And there is another interesting feature that is the halving, that every 4 years, in about every 4 years, the reward is halved, is divided by 2. So the rate of production of Bitcoins is divided by 2, so it decreases geometrically with time. And it makes that at the end, we will only have a finite number of Bitcoins produced that will be 21 million and no more. And we will reach this 21 million in the year 2140. Now, why we need a proof of work is because one of the basic principles of decentralization is that the network is open. Anyone can participate in the network. And you don't identify people that participate in the network, and you don't restrict people from participating. It's useless to identify someone to participate in the network because by the principles of decentralization, you cannot ban someone from participating. If you have an organization that controls the users and the nodes, then it's not decentralized because this entity can just corrupt the network by just admitting the people that have its own views and will maybe censor transactions, etc. So one of the basic principles is to have an open network, and this makes that identification of the nodes is useless. So this is something that is shocking from the regulatory point of view because by principle, a decentralized network cannot have KYC, which is exactly opposite of what happens in the banking system. If you want to participate in the banking system, when you open a bank account, the first thing you need to show is your identity, your credentials, etc. In Bitcoin, you don't need to show anything. You just download the software, not even an email. You download the software and it creates randomly a new wallet that you can use. And in this sense, it's much simpler than a bank account. Now, this protocol runs and relies on energy. And so this has been criticized because it consumes energy. And we have only two things that we cannot falsify in life, is energy and matter. And so for gold, it gives the value, the material, right, it is made that is not, you cannot replace by another, and you cannot do alchemistry and fabricate gold, well, except for nuclear reactions that have some residual gold that you can fabricate in that way, but it's the same for Bitcoin. You can, if you want to cheat the system, you need to put energy and so money and spend some money. Now, all right, so this is what I described, is that every 10 minutes we have a new block of transactions that are validated. And well, there are some nice features that the block count gives you a clock that I like, because as Ferdinando, I am also a physicist, and you learn this second law of thermodynamics, and you see that indeed in this network the information is being organized. And if you don't input energy in a system, you cannot not organize the information in the system. It can only go up. The entropy can only go up, but it's going down in the Bitcoin network. So you really need at least a minimal amount of energy that is input in the system. And well, I mean, if we want to be more technical, this blockchain has what is called a Bennett depth. So if you want to falsify the whole blockchain, that is just a set of blocks, you need to spend a lot of computation. And you can, well, provided that you make some assumptions about the functions, cryptographic functions that are being used, the hash function, etc. But provided that these assumptions are correct, because they are just empirical, you can prove that there is no way to falsify the whole blockchain without spending a lot of energy. Okay, now this is kind of a fast description of the network. And you know, a basic principle also is that this Bitcoin code is open, so anyone can download the code, can modify the code, can just create a new altcoin because it's open. If it was closed, it will be controlled by an entity, right? And then, you know, this entity could just change the code and make something different and corrupt it. So our basic principle also of decentralized systems is that the code should be open, verifiable, and anyone can modify. There's no really official code. There is a code that the developers have been using, but you can develop on your side the same code that respects the Bitcoin protocol rules, and you can use it. It's just about the protocol. Now, we'll talk a little bit more about these smart contracts. And what we learn from Bitcoin is that some of these basic principles of decentralized networks is that, well, I wanted to summarize it as liberté, égalité, and no fraternité. So it's like the French device, right? So liberté, why liberté? Because indeed, nobody forces the nodes to follow the rules or not. You can enter the Bitcoin network and try to behave dishonestly or not respecting the rules. That's fine. That's fine. It's just what happens is that you just will spend money on computation without getting a reward. And a mathematical theorem is that your optimal strategy is to respect the rules. So this is something very important, is that the general rules are aligned with the particular interest of the nodes and the participants. But you are free to not follow the rules. So it's completely free and open. Now it's just, if you don't follow the rules, just the network will punish you because your transactions will not be validated. Your blocks that you try to validate will be discarded by the network, etc. Now, so for example, you may want to cheat and create fake transactions just to control more Bitcoins, and you won't be able to do it unless you corrupt the whole computational power of the network. And égalité, this is very important, because some of the projects that we later seen do not respect it, is that all the nodes are equal. There's no difference. So strictly speaking, it's not true in the Bitcoin network, because right now, you know, there are some nodes that mine, some other nodes that do not mine, but you know, they are free to do it or not. I mean, it's just because mining has become a very specialized, and it's a full industry with special hardware, etc. But you have a strict equality with the power that each node has. Of course, it's balanced with it's weighted with the computational power of each node. Now, there is no police in the network, and this is something that is important. So there is no way to enforce the rules. There are no judge, there are no police. Nobody is going to force you to follow the rules. This is just done by having, as I said, these rules aligned with your particular interest. So if you don't follow the rules, you will punish yourself by not optimizing the rewards that you can get. But no police, and this is also fundamental. If you put police in the network, if you corrupt the police, you can corrupt the network. You know, this is one of the basic principles of decentralization. And so, of course, you also have freedom to join or to leave the network. Nobody's going to tell you anything. And what is important is to have thousands of nodes that run in small computers. If you start to require specialized hardware or big, you know, storage space, then suddenly you can have a node at home. It's not that expensive with a regular computer with 1 terabyte. You can run a node without a problem. Now, if you start to request more features and require more space or more computational power, then at the end you will end up with a few nodes, like 50 nodes, and then they can be corrupted because anyone can just enforce. I mean, for instance, if you have a majority of nodes in the United States government can enforce some rules on them and force them to behave in some way. All right, now another amusing feature is that this is a living network. I mean, you cannot kill it. I mean, you cannot stop it. And this is something very shocking for regulators and for countries that are used to rule what's happening, the finance in their country, etc. But this is international, has no boundaries. If you just kill Bitcoin or try to kill Bitcoin in one country, as for example, China decided that mining was forbidden or transaction is forbidden, they don't care. I mean, The network is everywhere. So if a hurricane comes to Florida and shuts down all the nodes in Florida, that's fine because the network continues to work. It's resilient in that way that, it's just some parts, you can work without some parts of the network functioning or being connected, which is also an important feature of decentralization. Because this is what guarantees that governments or other powerful entities cannot modify the protocol. Now, what we expect in the future, and this is the lessons we learned from Bitcoin. So the first idea that is very appealing is to say, well, I mean, I'm going to do this not just for a currency, but for many other human activities. I'm going to decentralize. I'm going to decentralize insurance. I'm going to decentralize finance, etc. So this is the natural idea. Say, well, we are going to do the same thing. It's not that simple. I mean, there was a kind of a blockchain movement in the banking system at some point that they wanted to decentralize banking and propose some what they call private blockchains that are not blockchains. If it's private, it's not an open network, and it doesn't have one of the basic principles of decentralization. But so what is hard and difficult is to build and imagine the protocol rules, for example, to create a decentralized insurance, how it should work so that all nodes all these general rules are aligned with the particular interest of the nodes. Satoshi Nakamoto has succeeded in doing this for a currency, for Bitcoin, that you can copy and create other currencies with similar features, but nobody knows how to do this in, for example, insurance and other tempting ideas, So it's something that mathematically is very complex and very difficult, and you need years of research in order to be able to achieve that. Now, what happens is that you can build other blockchains that are more smarter than Bitcoin. I mean, in Bitcoin you have these scripts, these programmable instructions that are very limited because of security reasons. And there are other coins that have taken the opposite approach, is to maximize the number of instructions and features in the programming language. So for instance, in Ethereum, they have a language that is Solidity, that is called Turing Complete, that can do more things than Bitcoin. For Bitcoin instructions, you have a very limited set of instructions as they are in a stack. So they're executing one after another, and you don't have loops. So in Ethereum, you can have loops, and you can program anything you want. And they took another approach. So this allows to build some programmable features. And one of the nice things that you can create tokens. This created the ICOs in 2017, etc. But you can also create decentralized exchanges. Now you can trade without having to go to an exchange. Classical trading in Bitcoin is to register in an exchange, and then you send some wire transfer of fiat money, and then you can buy currencies or cryptocurrencies, and you can trade them. Now you don't need to interact with any company or exchange. You can just trade with a smart contract. So you send a coin or a token in this smart chain, and you have pools of liquidity for all pairs of tokens, and you can just buy or sell these are called automated market makers, which are just smart contracts, which is a first step into the decentralization of finance activities. Now, another progress that is very spectacular and is becoming real is the Lightning Network. So on top of Bitcoin, you can, people criticize Bitcoin because you need to wait for a confirmation of your transaction to establish the payment. Now, using these smart contract features, you can open payment channels and pay instantly. So once this, and then you can compose these payment channels. Once this Lightning payment network is set up, the Visa payment network becomes obsolete, because essentially the fees for these Lightning payments are nothing. So, and certainly nothing compared to the fees that Visa charges to the vendors, right? So this is also to make a big disruption, and at the same time that we have Visa, we have all these credit card payments. Also, we have this money transfer, right? Western Union is going to become obsolete because now, instead of transferring dollars through their network, we can just transfer Bitcoin through a Lightning channel, and there are some companies that are building a big business with that. And in some countries, Now, for example, Bitcoin has become an official currency in El Salvador. So for Salvadorian people that work in the US, they can just send Bitcoins without with a minimal fee through the Lightning Network, and their families will recover Bitcoin in El Salvador, and they can exchange it with dollars or just spend them directly. Okay. So of course, Bitcoin is a currency. Well, I'm not commenting on all the monetary properties, etc. And there's a discussion about being it a currency or not. I mean, money has different properties, and different kinds of money have different kinds of properties. So Bitcoin has proved to be a good currency for storing long-term value, long-term meaning 4 or 5 years, but not for short-term value because it's very volatile, which is natural for a system that is putting into place. Now, how much time do I have? Because I have... No, but now 5 minutes, 10 minutes? Yeah, perfect. It's just to see what... there are some challenges for regulations. Now, I already mentioned some, is that the basic principles of decentralizations are sometimes incompatible with regulation. And the anonymity is a rule in the decentralized systems. And so decentralization and KYC, know your customer, rules are not compatible. And this causes a lot of trouble to governments and regulators. And of course, they try to do the KYC at the exit, so when people just sell their crypto for fiat, for euros or dollars, but at some moment, when enough commerces accept Bitcoin, this will not be possible. It's not a way of controlling. But they try to have some KYC on this. Of course, KYC has a very legitimate purposes to avoid money laundering and illegal activities, etc., that are minimal with respect to what we know. I mean, people steal the criminals, they use the dollar and the cash, etc. But for regulation, it's going to be something that regulators need to live with. I mean, sometimes they try to regulate things that are not regulable. You cannot regulate mathematics. So mathematical theorems are what they are, and you have the Pythagoras theorem, and you have the 2 + 2 = 4, and you may decide in the regulation that 2 + 2 = 5, but nobody cares. And indeed, there's a historical example. In some US state, they regulated the value of pi. They found that to have an irrational value for the number pi was not very simple, so they decided by law that pi was 3.14. That's it. But of course, nobody cared about this. So, I usually recommend the regulators to not being ridiculous trying to regulate this type of things. So again, you won't be able to regulate that people should do this and that on a decentralized system because the nodes wouldn't care. Now, so for instance, what people have tried to do is to use currency or commodities regulations to Bitcoin and cryptocurrency. That doesn't fit well. It's very hard to tell. So of course they don't want to implement currency regulations for tax purposes, because then currency exchanges are not taxed. You don't pay VAT for exchange buying dollars from euros or the converse. But also, at the same time, in the commodities regulation is not very appropriate. It's like gold. Gold is both a commodity and a currency. So some of the regulation with gold can be implemented for Bitcoin, but not all of it. And so there's a need for new regulation foundations. I mean, just it's fairly open, and probably also difficulties that it's international. So it's not because one country regulates something that is going to be implemented. And what the New York State experienced is that when they try to regulate companies that work with cryptocurrencies, etc. So most of the companies went away. So, this is the market. Now, some challenges. Sorry, let me start out. So we need oracles. So what are oracles? Oracles is what links the network to the real world. So if you want an insurance protocol, you will need an oracle that can certify that something went wrong, that there was an earthquake or there was a flight delay or whatever, in order to compensate the insurance, Now, so this is necessary if you want to link the smart contracts. And people know how to write a smart contract for an insurance. What is missing in a decentralized way is an oracle that tells you when the conditions of the insurance are met. Okay, so you don't want this to rely on a single company or a single person. You need to find something more sophisticated in order to do this. And one of the things that people do, they use these decentralized exchanges as oracles for price, which is quite a good idea, but you have to be careful because they can be manipulated. Some of the attacks, I won't call them attacks, that were described yesterday with in decentralized finance, which was the aim was to manipulate some of these decentralized exchanges so that it gives the wrong price and they can arbitrage this price. So I don't call these attacks because after all, people are just using the smart contracts in the way they are designed. So, I mean, it's just that, I mean, for example, also in finance, you know, there's something that was described yesterday that is called front running, and it's happening all the days, every day in trading, in real trading on the stock market. And so it's not considered an attack. It's just that there are some people that are smarter or they have the technological means to just see transactions before they are executed. They front run. So you have a big sell transaction that is coming. You try to sell before these sell transactions because then the price is going to go down and you can rebuy it. So this is the principle of high frequency trading, for example. Well. And in this network, you can do it in a more easy way because you see the transactions in the mempool before they are executed. Well, anyway, these are very technical stuff, but what I want to insist is that this is something important for the future, is to establish decentralized oracles. And now, what I consider to be the major challenge and what is missing in this decentralized world is to have a decentralized protocol for trust. So you want well, for trust or reputation. You would like to assign, okay, the entities that participate in a decentralized systems they are identified by some private key, so you don't know who these are, or maybe some people have different identities, but you want to assign a reputation and have a reputation system to give them credibility. If you succeed in building a reputation system, you solve the oracle problem because you can rely on the opinion. You will pay these people to be oracles, that they have a reputation, and they will provide a proper link to the real world. So this is something that nobody has done yet. And I consider this a very important problem that probably will take 10, 20 years to be solved. But once it's solved, this opens a multitude of possibilities for these decentralized protocols, and we can just imagine many activities in our society that can be decentralized that way. Now, not everything can be decentralized, okay? Because sometimes there are choices to be made, and there is no clear advantage of making one choice or other. And this depends on the ideology, on many subjective opinions of people, and you don't have a way of saying that, well, this policy is better than this other. So this you cannot decentralize, but other type of activities like an insurance, everybody agrees on what has to be done when someone, a catastrophe occurs and people have an insurance for some amount of money. This is automatic, right? I mean, you just need to do it in a way that cannot be manipulated. So many of these activities can replace most of the business that exists, but it's not for tomorrow. It's going to be the work for many years. So, well, this is what I wanted to do. So if you have questions, you have.
Thank you, Riccardo. We are already running late, but I will abuse my position of chairman for the only question we can allow for, and sorry everybody else. And I mean, don't trust, verify. This is pretty common in crypto and in the crypto space, and I do understand that this means like everybody is empowered and everybody can, let's say, verify a digital signature on its own. And everybody should do that. But don't trust, verify is not really convincing me, because you studied physics, I did too, and basically I know that in the lab I could have proven or verified any result, historical result, but I would have never graduated if that was my path. So actually, we always trust someone. We even trust people on, the robustness of the ACDSA protocol or the Schnorr protocol. So it's not really true about don't trust, verify. We trust a lot.
Yeah, but
Or we trust
one point I want to make is that in mathematics, you do really verify everything that you use. And I ask my students when they do a PhD, they need to be able to prove whatever result they use. So sometimes it's a bit complicated because there are some results that are quite tricky to establish. But I think the meaning of don't trust, verify is more don't trust and you have the freedom to verify. So it's up to you to verify or not. And of course, we all rely on trusted persons. And this is why a trust system is very important, because you trust someone for which they have a reputation. You're not going to trust the first guy that you cross in the street. So you trust someone on crypto because he has done something, or he has proved something, or she, you know. And so the rule is that, of course, we cannot verify everything in practical terms, and you are completely right. But if you want to verify, you should be able to verify. This is the key point. And for instance, we were talking the other day about checking the code of wallets. So certainly I didn't check the code of wallets. I'm not a professional coder, but I have friends that have done it, and I trust them. So when they tell me that they have checked the code as far as their knowledge and they considered it correct, then I trust completely. Maybe they are wrong. I mean, you know, it's just you know, they can be wrong, and but you know, it's a question of, and if I want to verify, I can do it. I will have to learn some cryptography, some coding, and I will do it. It will take me a lot of time, but I have the possibility of doing. It's completely different from when you take one of these decisions of a central banker that tells you to trust him that inflation is good. Then you don't have a way to verify. You don't have the possibility of checking that. If they cite papers in economic journals that you know, you can make them say one thing or another. So okay, then I prefer a simple system. It's a simpler system of a code that I don't understand, but I can understand if I want, than the algorithm that is not an algorithm that they use in the central banks. From
okay,
this point of view,
one more question from the remote attendants. That yes. So another exception straight away. And it's like, what is your opinion about the Chinese ban of Bitcoins and crypto?
Well, I mean, this Chinese thing is coming, I mean, every 2 years we have a Chinese news. And the first was, oh, Bitcoin is bad because all the mining is in China. And now China has decided that no mining is there, which is not true either. And they have banned recently Bitcoin transactions and cryptocurrency transactions, but they did this 6 years ago. I mean, come on. I mean, this is just the Chinese right now, they have in the agenda of building a crypto yuan, and they don't want to see a competitor like Bitcoin. I mean, the simplest thing for the central banks or the crypto digital currency will be just to adopt Bitcoin as the Salvador has done. But they don't want this because they cannot control the monetary mass. The monetary mass in Bitcoin is established by a formula, and nobody has the power to change it. So nobody can manipulate the monetary mass. So the central bank digital currency, the CBDC, is like a shitcoin where it's pre-mined, so you don't buy a shitcoin that they have pre-mined everything, right? Because you know the developers are scammers. And you don't even have a white paper where establish how much coins you have and if they are going to issue more. So okay, you choose, you choose. You can. I prefer Doge than a CBDC. I mean. You do whatever you want, but because why I prefer this? Because I can verify. I know how it's going to work, the monetary issue. And at some point, there is developers that change that, and there is a foundation behind. It's not totally decentralized, so I will trust less. But for the moment, the most trustable, well, I won't say currency because it's not used as a currency, but it will, is Bitcoin, because you have very clear rules and you don't have a foundation. You don't have anyone that has the power to change the way that Bitcoins are minted. Okay.
Thank you, Riccardo. Very much appreciated. And thank you for being available and for such provoking thoughts. And we move over, and I leave the floor to Gianfranco for the investments and trading session.
Thank you, Ferdinando. Thank you. Thank you to all the participants on remote and here in present. I want to thank you, the organizer of this conference, the University of Milano Bicocca, the Digital Gold Institute and the GRC of the European Commission, and a special thank also to our sponsor for the financial support. Our gold sponsor is CheckSeek and Deloitte, and the silver one is Elidata. In this panel, we have 3 papers. The first one is titled Order Book Liquidity on Crypto Exchanges, and will be presented by Marius Gramlich of the University of Liechtenstein. They provide evidence on the liquidity phenomena in this market using intraday data from 4 exchanges. What is really interesting is that they analyzed the entire order and trading book. So please, you can go on, Marius.
All right. Okay. Hello, everyone. Welcome to my presentation, Order Book Liquidity on Crypto Exchanges. And thank you very much for the conference, for organizing, and welcome the people here in person and on remote. Just a question, I see a different screen here and here.
Don't worry.
No worry. Oh, okay, perfect. All right, yeah, Order Book Liquidity by Martin Angerer, Michael Hanke, and myself. All right, let's start with a quick introduction. In recent years, cryptocurrency had gained importance in various ways. I think that's why we are all here. We have central bank digital currencies as a topic, non-fungible tokens, and so on. And from one other perspective, cryptocurrencies are more and more recognized as a new asset class, and even more investors entering the market. And this is also supported by the development of altcoins. We know there are almost more than 3,000 already of them. And these altcoins partly outperformed Bitcoin already in the recent years. So there are many reasons for cryptocurrencies to be regarded as an asset class. And these developments have spurred a lot of new research of cryptocurrencies and are recognized more and more over time. So quickly, motivation why we are looking at the liquidity of cryptocurrency exchanges. I think the slide is not complete, but it's all right. So far, the research mainly focuses on Bitcoin because it's, in terms of market share, the most relevant one. And another point is that the data is mainly price data to observe returns and volatilities. And we try to incorporate in our research the altcoins on the one hand, and to derive our results from order book data and not from price data itself. And on the other hand, why are we looking at liquidity? It's of very high importance for cryptocurrency investors as well, but it has not received that much attention. This has 2 reasons. On the one hand, there's no broadly accepted concept of liquidity in the literature. And on the other hand, the order book data itself is very hardly to obtain. So this is why we use here liquidity measures which are applicable to all trading pairs in the crypto market. I come to that later because why this is very important. and to allow us to compare the results across exchanges and currencies. And why is this relevant itself? Well, on the one hand side, it's very relevant for the academia, because this is a very important indicator of and an requirement for market efficiency. The very lowest level of market efficiency comes from operational efficiency. This is that trading can happen with high reliability and at low costs. And these costs are very relevant for investors as well, because these are mainly driving their profit or losses. And these, if we can split up the transaction costs in its roughly two parts, explicit costs on the one hand side, which are for the exchanges themselves, for brokers, financial intermediaries, and in the implicit costs, which are mainly driven by liquidity. And intuitively, the higher the liquidity, the lower the implicit costs. All right, so how do we try to answer this question? We have order book data from the exchanges Binance, Kraken, Huobi, and OKEX, which were provided by CryptoKick. And the time frame is from the 1st of January 2019 to the 13th of September 2019. And we have 24/7 limit order book data, as we know. And a very special feature about this is there are no auctions, opening auctions or closing auctions for this market for days, so that liquidity may be shifted to central points in time, or that there are any gap risks, etc. And from this data, we created 5-minute order book snapshots. So we have 288 order book snapshots per day to measure our variables. And we have some filters to ensure data quality, which I will not further mention here. You can look it up in the paper. Just some terms we use here. So we have cryptocurrency pairs. So we have, for example, Bitcoin against Tether. And in this case, Bitcoin would be regarded as the target currency because it is labeled as a quantity in our order books. And we have Tether, which is labeled as the base currency because it is defined as the price in our order books. And each combination of target currency and base currency will be labeled as a cryptocurrency pair or a trading pair. All right, quickly look how our data looks like. From the very top perspective, we have the 4 exchanges, and we have some numbers of base currencies, target currencies, and trading pairs. And we can see that there are a modest number of base currencies. Binance is maybe an exception with 11 base currencies, but Huobi, Kraken, and OKEX have roughly the same number of base currencies. And the number of target currencies are, there are very large differences. So we can see that some exchanges provide investors with more target currencies and others with less. And even more interesting is the number of trading pairs which are resulting, because there we can see these variation even larger. And this table may show you that there's not only market fragmentation among the exchanges we have, but also within the exchanges themselves. In the case we have 514 target currencies, even if there are a maximum of 161 target currencies, and we have 514 trading pairs. So if we can go one step lower, we can see that these exchanges also provide different types of base currencies. We roughly distinguish between 3, the fiat currencies like dollar, euro, etc., stable coins, which are only USD pegged stable coins, and the other currencies like Ethereum, Bitcoin, etc. And the last table shows the target currencies and trading pairs which are traded on each exchange, and how many are traded on all of them. And we can see that 71% of the target currencies are only traded on one exchange. So there is this need to find measures to compare the whole market and all currencies so that we can capture the exchange, crypto exchange market as a whole, and not only specifying on the common trading pairs, which only allow for 1.4 or 4.3%. All right, so what we are doing, especially, we choose some liquidity measures which can be applied to all trading pairs and to make them comparable regardless of their currencies. And this is why we are very selective, because many liquidity measures keep either the units of the target or the base currencies in their outcome. For example, trading volume. Trading volume can either be measured in the number of currencies we trade or in the value of the currencies we trade. So, for example, this is why we disregard transaction costs, but we come up with another proxy for transaction or impact of trading on the next slide. And we generate daily values for liquidity measures by taking the average of the whole day for the 288 snapshots and then look at the results for the whole time period. And only one exception is, again, the next measure I present on the next slide. All right. So this is maybe the most important measure we have in our paper, the order book slippage on an intraday level. So quickly how we measure it. We measure the mid price of the previous 5 minutes and where's the mid price now in the next 5 minutes. And the mid price, we try to find a level on which the mid price minimizes the difference to the next prices. This shows us how much the mid price slips within 5 minutes. And then we do it for both, for the bid and the ask side. One is by definition always 1, and then we take the maximum out of both levels. And as a result, we have two variables. We have, on the one hand, the average slippage for the day, which is defined as the usual price deviations within one day. And then we have the maximum slippage for the day as well to capture the worst case scenario. And the difference between them will account for the slippage risk. And the slippage accounts for two liquidity consuming factors from a very narrow order book liquidity perspective. We have cancelled orders and trades, but trends, we are expecting that these results are mainly driven by trades because we have not found any evidence in the literature that cancelled orders are responsible for any price changes we can observe. So, and a very big advantage of this measure is that we can apply them to all cryptocurrency pairs. And we can measure actually how the order books can supply the liquidity demanded by traders in these cryptocurrency pairs, regardless of if this trading pair is famous or not, if it's Bitcoin against Tether, or if it's, I don't know, Shibu against Ethereum. And these two measures, I quickly go over it, are spread measures, imbalance measures, which are commonly known in the literature. And for example, the spread measure is regarded as a liquidity premium, which has to be paid to immediately execute an trade. And the imbalance measure is a measure to capture if there's a very large amount of bid orders over ask orders or vice versa. And this is commonly also an evidence for higher trading costs in the market. All right, quickly go to the results. Here you can see the exchanges, the base types, and the mean and the max slippage, as well as the relative spread and the Anobi results. I go quickly over it because time is running up. You will see, if you look closer on it, that there's a negative relationship between spread and Anobi and mean and max slippage. So the higher the spread is, or the Anobi is, the lower is the slippage, and vice versa. But why is this the case? We can only imagine that these results are driven, that slippage is endogenous. So that slippage can be explained by the spread and Anobi, because if we can just think about the several circumstances we can think of. For example, if the slippage is purely exogenous, there would no relation be with the spread and Anobi measures. And we can even think about if the spread and Anobi are endogenous, then the slippage would cause even higher spreads or higher order book imbalance. But both is not the case, so we come up that slippage is endogenous, and we try now to explain slippage with these two other measures. And this is what we did here. So we run actually 4 regressions, a pooled OLS model and 3 fixed effects model, just to first find out what kind of model we should use. We can see that the results are intuitively the same. We have negative signs in front of each variable, and but we can find in the last row that there are individual effects, time-fixed effects, and both. And the time-fixed effects and so the time-fixed effects are time-dependent, and the pair-fixed effects are trading pair-specific effects. So I am coming to an end soon. All right, so we have. So since we have very significant results here, we imply that slippage can be explained by spread and imbalance. And if we go back to that slippage is mainly driven by trades, we can also imply that large trades are timed for phases with high liquidity. And quickly, we split up our results also for negative and positive imbalanced order books. And then we can find stronger results for spreads and imbalances for negative imbalanced order books. So if there's a higher depth on the bid side, it contributes more strongly to a lower slippage than the other way around. And this actually can explain price drawdowns and panic selling behavior, because if the traders observe decrease in selling opportunities or in increase in selling offers, they try to or accepting higher spreads to sell their orders, to sell their assets. All right, just to conclude, okay, we have used the standardized liquidity measures to capture the special features of crypto markets. We have contradicting results for liquidity on the slippage versus spread and imbalance, and we can find some evidence that orders are timed and that traders are accepting higher spreads to sell their currencies. All right, thank you very much for your attention, and I'm looking forward for feedback, discussion, and questions. Thank you.
Thank you very much, Marius. We are out of time, so I will do only one question by me, okay? I'm curious about the main finding in your paper. You found that the slippage will be larger when the liquidity is higher. So this is counterintuitive, but is revealing to us that probably large institutions, large investors will try to find those moments of high liquidity. Have you considered to divide your sample to verify if which is the real behavior of the institutional investor? For example, understanding better if they use a specific exchange, a specific currency pair. It is possible, you know, on your.
We can look at slippage for each currency alone, so we can do that. I think we did it only for so far only for the exchanges and for the base currency types we have, but we can go even lower, even step further to look at the base currency itself or the trading pairs themselves, which causes the highest slippage. Yes.
Okay. Thank you.
Thank you.
Now we go through the second paper of this session. The title of the paper is Intraday Earning and Attention Around the Clock. The paper is presented by Stefan Scharnowski of the University of Mannheim. Also in this paper, the authors derive their findings from an intraday dataset. So please, Stefan, you can go on.
Okay, thanks for the introduction. Thanks for having me here. I'm going to present this paper on intraday herding, which is joint work with my colleague Yang Hua from Mannheim. So what do we mean when we talk about investor herding? Well, in a nutshell, it's about the inclination of some investors or the behavior of some investors to follow the market and potentially disregard any private, any fundamental information that they may have regarding the value of an asset. So expressed differently, it's about the co-movement of returns in certain situations. So returns of individual assets in the cross-section at a given point in time are closely following the market. There can be multitudes of reasons for this type of behavior. Some of this can be very rational. Think about like informational cascades, where some investors are informed and others are not, so that would be a rational example, but it could also be irrational when I really disregard fundamental information. And of course, this is interesting to academics because we want to understand the behavior of investors, but it's also potentially interesting to regulators because we want to avoid any price bubbles that we can have from this positive feedback loop that would be associated with irrational investor herding. Now, this behavior has been documented in many different markets. We see this across asset classes, like equities, bonds, ETFs, FX market, and so forth. We see this all around the world. Many studies studying this, not just in the US, but also in a global setting. We see this across different industries. We see this for retail investors, where you may expect this, but we also see this for institutional investors, and we see this at different trading horizons or different frequencies, and importantly for this conference, we also see this for cryptocurrencies. Well, there is a lot of research on this, but so far these studies don't really agree on the size or even the direction of this effect. So some studies find something they call then anti-herding behavior, which would be the opposite of herding. So we think there's room for yet another study on herding for cryptocurrencies. So we reconsider this issue, particularly because we think that the crypto market is really interesting, not just because cryptos are interesting, but also interesting to study herding, because it allows us to test a few things that we can't really test with many other assets. Important for this study is that the crypto market is open around the clock. So you can, in a global setting, at any time of the day, you can trade cryptos, which doesn't really hold for many of the other assets that have been studied so far when it comes to herding. Of course, some of you might disagree regarding the fundamental value of Bitcoin, where it comes from. But because we have this disagreement, that kind of shows us that it's not quite all that clear where this value comes from. What is the fundamental information that investors would trade upon for Bitcoin and other cryptocurrencies, especially smaller altcoins? That's interesting. The market is young, developing, and the investor base may be different, or it's definitely different from many other asset classes. In particular, we have more retail investors in cryptos than, say, for example, in the FX market. So we use intraday data to study this phenomenon. Well, firstly, because we have more power when we use intraday data. Some of the herding behavior might be short-lived, so using intraday data will allow us to pick up this short-lived behavior, where many previous studies were using daily data, which may work to some extent, but really if you think about intraday traders, they might follow the market at much closer intervals than daily. So that's one reason we do that. Another reason is that, well, this market is open around the clock, so with intraday data we can look at patterns that we observe throughout the day in herding, just like we have documented patterns in volatility and liquidity, and trading volume, and sometimes returns. But that's not all we do. Another aspect to our analysis is that we link this herding behavior to investor attention, one of the potential determinants of herding behavior. And we not only link herding to kind of the level of investor attention, which has been done, well, the level of attention has been used, not just in the context of herding, but more generally in many contexts. But another thing that we do is we look at the dispersion of attention. So remember, our measure of herding is going to be some kind of measure of dispersion around the market return. So using that same logic for our measure of attention, we can look at kind of the dispersion of attention. So is attention directed towards like all cryptocurrencies, more or less in a similar fashion, or is attention directed towards specific cryptocurrencies? And we would expect that this would decrease herding behavior. And to the best of our knowledge, no one has really linked attention the way we do this to herding in crypto markets, and for sure not when it comes to the dispersion of attention. And that really holds for many other asset markets. I'm not aware of many studies that do that. So more formally, this is our measure of an investor herding. It's a two-step process. So we take the cross-sectional deviation of returns from the market, so the absolute value of that, and then in the second step we regress this on absolute and on squared market returns. The idea here is that if you have a rational linear asset pricing model, think of the CAPM or a conditional CAPM, something like this, then you would expect that the cross-sectional deviation of returns increases in returns, and then the magnitude of returns to some extent. But if this increase in dispersion kind of decreases the higher returns go, if we think about increasing returns for a second, then that would not really be consistent with a linear asset pricing model. So in this two-step process, we take this cross-section absolute deviation of returns, this dispersion around the market, and then see how this is impacted by extreme returns. And if we find something significant for this beta 2 coefficient here, then that would tell us that we have significant herding behavior. In particular, if this coefficient is negative, with the absolute returns, we're already controlling for everything that the rational asset pricing model would predict, but with the squared returns, we can pick up this herding behavior. Now we repeat this type of analysis for many subsamples using various types of fixed effects, and because we have this intraday data, we can interact all of these coefficients with dummies for every hour of the day, and thus study these intraday fluctuations or intraday patterns in herding behavior. This is what we do in this last equation here. And I have to say that this is a pretty standard approach in the literature, at least this like two-step process that has been done many times. That's not something we're proposing. How do we then do this? We use a sample of 13 cryptocurrencies of various market sizes. We don't have any stable coins or anything like that in the sample, because there this whole concept doesn't really make a lot of sense. We have about a bit more than 3 years of data. It's all at an hourly frequency, so we have exchange rate data that is expressed against the dollar, and we also collect data from the blockchains of all of these cryptocurrencies to get the number of transactions that happen in each 1 hour window of the day. And then importantly, because we want to link investor herding to attention, we use two proxies for investor attention, and these capture kind of slightly different things about investor attention. The first one is Google search volume, which is more the information demand side of attention. So I go to Google and I look for information. And then we also have Reddit posts where we capture more the information supply side of investor attention. And then very similar to what we do with the herding measure, we look at the cross-sectional variation around some kind of market level of attention. Yeah, so here we have our results. Let me just highlight the most important things that we do find. So the evidence for investor herding, that's something you will see in this second line here. You will see that all of these coefficients and all of our specifications are negative and significant, so that would be some indication that according to this measure, according to this model, investors do indeed herd around the market returns. So we do find evidence for that. And we think that especially because we use intraday data that allows us to pick up this short-lived herding behavior, that might be one of the reasons why we can very clearly show that this behavior is present in the market. We look at some potential determinants of herding behavior. So in all of these regressions here, the cross-section absolute deviation is the dependent variable. Of course, we have absolute and squared market returns in here in the first two lines. Then we include trading volume and the number of transactions on the blockchain. Now, we use data from Bittrex here, which is at least partially in our sample, a US-centered exchange. So you have to take the results here for trading volume with a grain of salt, because we're not capturing the full crypto market. Nonetheless, we do find that if there's more trading volume, then the cross-sectional deviation of returns around the market increases, which would be an indication that market return herding is going down, or herding in general is going down. This holds in all of our specifications. What is maybe a bit more puzzling is what we find for transactional activity on the blockchain, because there it really depends on kind of the time horizon that we look at. In some of our models, we include day fixed effects, and these would take care of any like longer term trends in herding behavior. If we do not include day fixed effects, you see that the coefficient for blockchain transactions is negative, so more transactions are associated with less of a dispersion of returns, so more herding. But we find the opposite if we include day fixed effects. So there seem to be kind of opposite economics at work when it comes to short and long run effects. Much more important than what we have for blockchain transactions, in my opinion, is what we find for our proxies of investor attention. And you would see that all of these proxies in pretty much all of our specifications are significant. So if there's more attention, then there's more dispersion of returns around the market, so less herding, which is, I guess, pretty much what you would expect. So if we have a higher level of attention, people herd less. If we have a higher dispersion of attention, people herd less. And both hold for information supply and information demand. We break this up into different subsamples to see if there are times when investors are more prone to herding versus other times. We do find, consistent with some other studies, but at odds with many other markets, that investors herd more when prices are increasing. So this would be consistent with the story of kind of fear of missing out, which has been documented in other contexts in the crypto market. And we also find that there is a bit more herding when volatility is lower, which I think goes also with a kind of fear of missing out story. Then, because everything that we're doing has this intraday dimension, we can look at how attention fluctuates throughout the day. You can see here search volume. It does vary a little bit throughout the day, and in particular it varies differently for different cryptocurrencies. So the dispersion of attention also changes throughout the day. So here these are averages across our whole sample. This distribution here would be bimodal for search volume. If we look at Reddit posts, that's more, it seems centered in the West, if you will, and in Europe and the US. So here we only have one peak and it moves a bit closer together. We see less fluctuations in attention for the bigger cryptocurrencies like Bitcoin and Ethereum, whereas for the smaller cryptos we find a bit stronger fluctuations. And you notice here in all of these graphs, but we don't know where the traders are located, so we're agnostic on kind of the time zone convention, and we just plot these different timescales here. Putting everything together at an intraday level, I think this the graph here well summarizes some of our results. You see in the black line here with the shaded area the intraday coefficient of herding. If this is negative and significant, we have evidence of significant herding behavior. So you can see that in kind of during the second half of the UTC day, we have substantial investor herding, but less so during the first half of the UTC day. Very, very roughly speaking, this is also the time when more people are with internet access globally are likely awake. This is really hard to estimate. We do some back of the envelope calculations on this in the paper, and it would be consistent with that. At the intraday level, you can see again, more blockchain transactions are associated with more herding. That's this at the short horizon. And you also see that Reddit posts show kind of a similar pattern at the intraday level, meaning that we have more Reddit posts when we have more herding, but for this other dimension of attention with search volume, we don't find at the intraday level that goes slightly in an opposite direction of what we find with Reddit posts. We do many robustness tests that I'm going to leave for the paper during this presentation to finish on time. So to conclude, we do document significant market return herding behavior in the cryptocurrency market. We find that herding is stronger when prices are increasing or when volatility is low. We do find that return herding is negatively related to both the level and the dispersion of investor attention. I guess this is consistent with economic predictions that you would make. It fluctuates throughout the day. It's stronger when likely more people are awake. And overall, we think that this evidence is consistent with the presence of retail traders that do herd around the market return. So thank you, and I'm open to any questions or suggestions that you may have.
Thank you very much, Stefan, for staying in time and for the clear presentation. Any question from the floor? I have a question for you. As you say at the end of the presentation, your findings are related to the hypothesis of retail traders that fuels this herding behavior. Do you have in your sample data to divide in subsample about the amount of transaction coming from the exchanges or the blockchain to understand if the results will change with a cutoff on the value of the transaction? It is possible. It could be interesting to understand better if are retail traders that cause this herding behavior.
No, we don't. I think that's an excellent point. That would be very interesting analysis. I think implementing this is tricky in our setting. I mean, we just look at kind of hourly prices and how we have returns. So the measure that we have, the upside is that we don't have high data requirements. The downside is that many of the things that you would like to test, like transaction sizes, for example, we don't observe that. Now, we do have volume in there, so maybe that could be one angle of tackling this question. Higher volume associated with institutional investors. I don't know, it could just be more retail investors, so that's tricky. I guess we could get more data from the exchange to see how trade sizes look like. The problem is, of course, that in general, arbitrage opportunities between exchanges aren't that large, especially for what we're picking up here. So prices would be pretty similar across exchanges, but trading volume and trade sizes and all of this, that will differ. So to really answer your question, we would need to get data from not just one exchange, but really all of the exchanges. assuming that within seconds prices would align on other exchanges as well, even though there you might have a totally different investor base.
Okay, thank you very much.
Thank you.
The mic.
Yeah, I was looking at your results that you have significant return earning when the market is up and when there is low volatility, which is kind of strange. And I wonder whether you can add information about news, how the news come out, you know, in Bloomberg, maybe not Bloomberg, in what is the platform which was
Twitter,
Twitter,
Reddit,
when
Telegram.
there are tweets, using tweets, an index of how it spread the information, because you're talking about retail traders. Also in the other one, which became famous because of the Reddit, yes,
Reddit,
yes,
yeah.
you already have Reddit. So yes, it is
Yeah,
significant.
We do have Reddit posts here. We're just counting the number, really. We're not looking at the content, so that's where we
Yeah, the
take
sentiment.
this. Yeah, it's just attention, really. I mean, many people kind of mix these terms together. We say that it's really just attention because we're just capturing how much is being searched and how many people post and all that. Not really what they post, so we don't know about sentiment. Of course, the sentiment in these posts might correlate then again with increasing or decreasing prices, might explain some of the splits that we have. Though, of course, none of this is really exogenous, right? So this is just correlations. There's no exogenous shock or anything. Regarding other news, I mean, I guess we could take Bloomberg data to see if that captures more the institutional
Well,
side
you
of
can
things.
use as an exogenous shock what happened at the beginning of January on Reddit and the GameStop and see, because also they were interested in.
I mean, we don't have Dogecoin in our sample, so some
Okay.
of the shitcoins are in there, which would, I guess, be the most impacted part of this. Yeah, and then you suggested Twitter data. Twitter data is much harder to work with. Just getting this for all of the cryptocurrencies at an hourly level. I mean, this is really one of the challenges with this analysis, that it's hourly data, and that would require you to basically go to the Twitter API and then crawl all of this, which we've thought about, but I'm not sure if this adds that much compared to Reddit. But thank you. Anything else?
Thank you, Stefan,
Thank you.
for the presentation and the answer. Now we have the last paper of this panel. The title of the paper is Bitcoin and News Around the World. The paper will be presented by Marco Petracco of Joint Research Center of the European Commission. The authors use a unique database automatically built by the European Commission, Europe Media Monitor. This is a really interesting database because it's composed of traditional papers, articles, and digital ones. So they try to relate these with the trading activity in crypto market. Marco, are you online? Can you hear us?
Not managed to. Can you hear me?
Yes, we hear you.
Okay. So good afternoon, everybody, and thanks for allowing me to present this paper. This, as I just said, is Bitcoin and News Around the World in 26 languages. It's joint work with Lucia Alessi, Eric Geisels, and J1. And of course, sorry, okay.
We don't
Of
see
course,
Marco.
the usual disclaimer
We don't see
applies.
Marco.
Hello?
Okay, Marco, you
Okay.
can go on.
Okay, fantastic.
Yeah. So of course the usual disclaimer applies. These are personal views and not institutional views. So these are the contents, but in the interest of timing, let me just move to problem definition. So as we all know, cryptocurrencies are quite famous for their high volatility. There have been a series of episodes of high volatility over the last few years. And there is research pointing to the fact that price discovery seems to be noisy for cryptos with respect to other classes. In fact, we even have research questioning the existence of a fundamental price for cryptos. And so an interesting question in general, is this volatility is driven by fundamentals or by any other factor? And within this question, we would like to focus on what is the role of sentiment and news for the pricing of cryptos. So in order to do that, we rely, as anticipated, on this sentiment scoring from extracted from a unique data set that is built based on the Europe Media Monitor, which is a system developed by other colleagues in the Joint Research Center for monitoring news media, and on high-frequency data on Bitcoin quotes from Kaiko. And we use a relatively long data set, time span, that goes from April 2014 to August 2020. So what do we do in terms of data from Europe Media Monitor? Well, let me just present what EMM is and then how we work with the data. So EMM News Brief is an automatic system that collects and analyzes news. It monitors a list of news media from around the world in up to 72 languages. And the sources include most major online newspapers, but also other kinds of news outlets, and also a set of specialized news outlets. And for Bitcoin in particular, there is a set of more specialized websites and other online forums, but not social media for the moment. The system downloads, captures these the news as they come out, scrapes them, finds entities, events, assigns them to categories, and among other things, it also calculates a sentiment score. And in particular for this work, we've been working with what is called the JRC tonality score, which is based on a bag-of-word algorithm. It assigns scores for slightly or strongly negative or positive words, and it then normalizes by word count. And what is interesting is that this bag-of-word is basically translated in all of the languages the system works in. So what we've been doing is that we have been taking articles belonging to the Bitcoin category, and the inclusion is based on a set of keywords and other semantic criteria, such as maybe some words will give a negative score or lead to being excluded from the category. And this category over our time span leads us to extract about 400,000 articles in 26 languages, about half of which are in English. And the data that we use is the timestamp, the language, which we divide in English and other languages, and the tonality, calculated as I was saying before. In terms of price data, what we do is that we rely on returns and net buy from 6 exchanges in different regions, in Asia, Europe, and the US. And we selected these exchanges from those available within Kaiko because they both had a trading history to match our EMM sample period, and we had the high enough trading volume to alleviate potential liquidity issues. So what do we do then? Is that we take our 400,000 articles, we divide them we divide every day into 24 periods, and we calculate the average tonality over each 1 hour period during the day, both for English articles and for articles in other languages. And we retain data for all intervals where we have both categories appearing. And basically we retain more or less 70% of our intervals, that is about 30,000 1-hour intervals. And then we calculate return and net buy on each 30-minute, 60-minute, 1 day, and 1 week interval, following each of the intervals for which we calculated tonality. So we have a 1-hour interval, and then the returns and the net buy over the next half hour, 1 hour, 1 day, and 1 week. And once we have built this data set, we run a logistic regression from the sign of the returns on the tonality of the English language and other language articles in the hour before, and then a set of controls that include a macroeconomic sentiment index by Fed San Francisco and some dummies for excess disparity of sentiment between English tonality and other news tonality. And we do an estimate with both pooled and fixed effects by exchange. And we are mainly interested in the sign of the significant coefficients for news sentiment in English and other languages. And so these are basically the results that we have. Here is the result of the pooled regression. We have returns and net buy in the two panels. You can see that for every 1 hour period of our 24 periods, we report the sign of the coefficient for English language news tonality and other language news tonality over the returns over the next 30 minutes, 60 minutes, 1 day, and 1 week. And what we can see is that there is an excess number of positive signs with respect to what we would expect to happen randomly for the 30 minutes and the 60 minute interval, especially for the English language. And on the other hand, we seem to have an excess of negative signs over the 1 week period. So on average, it seems that returns are positively correlated with English news tonality at short time intervals and negatively correlated at the longest time interval. Whereas for net buy, we do not seem to see such a strong correlation. And if we move instead to look at the results over different exchanges, what we see when we are employing fixed effects, we see that the excess of positive signs, positive correlation between tonality and returns seem to be maintained for most of the exchanges, but for Bitfinex and Bitstamp, both the 30 minutes and at the 60 minute, these relationships seem to disappear. And on the other hand, especially at the 7 days, at the 7 days interval, we seem to observe an amount of negative signs. And also what is interesting is that you will have seen from before and also here that the time frames at which these signs are located are basically the times, as said in the previous paper, where most people are awake. If you look at globally, when most people are awake and active, these seem to be the hours that are where most people are around. And for net buy, again, we have some coefficients that pop up. So the relationship is more significant than for the pool regression when we allow for differentiated intercepts across different exchanges. And the thing here is that we need also to investigate further is that some exchanges seem to have a prevalence of one sign over the other. So if you can see, Coinbase seem to have mostly or only negative signs, whereas other exchanges seem to have only positive signs. And I mean, this needs to be investigated further because there has been other authors that in the literature have been suggesting that specific exchanges are being used maybe by noise traders or other traders to for some specific functions. So that could be in that direction, or of course it could be an artifact due to other reasons that we need to investigate. And so in terms of kind of conclusions, that what we can draw from what we have seen is that we see that we have a positive correlation between tonality and Bitcoin returns over the next 30 minutes and 60 minutes. And this seems to agree with previous research pointing to a role for sentiment in determining returns, and with the fact that news sentiment could be affecting short-term and intraday returns. And there is also an effect of a reversal of these effects over a longer time horizon, especially at 7 days. And again, this seems suggestive that Bitcoin could be subject to a more extensive noise trading than other asset classes, and that price discovery in Bitcoin markets could be subject to a large amount of noise. And this is also further supported by the analysis of results at the individual exchange level, where these effects seem to appear on Bitfinex. And there have been other authors that have reported having found more efficiency on BTC exchange in Bitfinex. And NetBuy dynamics were more muted at aggregate level, but different exchanges seem to respond more to news. So some exchanges seem to respond more to news. So in terms of further research, of course, I mean, these seem to be opening up quite a number of additional questions. And especially we can observe that relationship seem to be inverted for non-English language news. And this could point to a different use of news by noise traders in different countries or different languages, or to the existence of other dynamics in news tonalities across different languages. And these will need to be investigated further. I mean, we have to check if there is a lag moving, say, between English and other languages, or other phenomena are occurring, or if there is an artifact of some kind. And NetBuy dynamics also seem to be compatible with interest and noise-driven dynamics, or with different roles for different exchanges. And so also these points to further question that needs to be investigated. And the other thing is that it would be interesting because it seems that there is some predictive power in the amount of news if knowing the tonality of news would allow to prevent one market one-sidedness, and at least in its more extreme cases. And finally, the other thing is that it has been said in other papers here, it would be interesting to include, besides news media, also social media sentiment. And in fact, we're now working on extending these to Reddit and Twitter data. So I think that this completes the presentation. It seems I've always, I manage also to be a little bit ahead of time. So I'll give the floor back to you.
Yes, perfect, Marco. You are in time, and let us to not to be too late in general. Any question from the floor or the audience online? One question. Yes, please.
Can I go ahead? And so the main message of this work is that we observe more volatility due to the news for the movements in valuation in Bitcoin. Can we also extract some policy recommendations from this message? Because I understand, it's kind of intuitive, this kind of work. But what I'm thinking about, if we can have also some policy implication based on this main message, which is pretty strong from this very good paper. Thanks.
Well, I would say, in terms of policy implications, of course, this in a sense confirms that for the time being there is, I mean, I can see an angle from, I would say, maybe consumer protection in races. This seems to confirm that there is quite a large amount of noise trading in this area. So basically the kind of advisory that applies to investors. I mean, just be sure that you know what you are doing when you are investing in Bitcoin. And say, especially very short-term, highly speculative trading is probably something that is very risky. So that is probably something that could be in a sense confirmed by this kind of work and by other works that we have seen over the last days. And I would say that from the point of view of financial stability, it could be interesting to try to see if one is interested in extreme one-sidedness of the market, of market movement. It could be interesting to monitor news and try to see if it could be possible to have some predictory power of extreme movements from one side or the other of the market. Thank you. Thanks for the question.
Other questions? Okay. Thank you, Marco, and see you soon in presence. Bye.
Thank you.
And thank you also, Gianfranco, for moderating this session, which is now the turn for the sponsored speech. And as I already said yesterday, this is a very interesting conference because even the sponsors have quality contributions to the topic that we are discussing these 2 days about crypto asset investments and regulation. And today we have as a guest Paolo Gianturco, Senior Partner of Deloitte Consulting, that will be presenting digital assets and the futures of financial services. That is basically a presentation, a comment of Deloitte's 2021 Global Blockchain Survey. Thank you, Paolo. Of course, thank you for sponsoring the conference. Deloitte is a gold sponsor along with CheckSig. Early Data is silver sponsor. And thank you for supporting our effort, both with the sponsorship and with the content of your presentation. So the floor is yours. Thank you very much.
Thank you, Ferdinando. Thank you for the organization, the energy you and all the team is giving to this event. I'm not in the video, no? Just the speaker. They don't see me. They do see you. Ah, okay. There is a ghost webcam. Okay, yeah, perfect. Yeah. Thank you. I hope that we can share some interesting information from Deloitte. So going to the point of my presentation, the idea is today to give you a very short description of what Deloitte see globally and locally. So the state of the art according to our view about crypto market and blockchain. So we got 3 sources. One is the Deloitte Global Blockchain Survey, as Fernando mentioned before. The second is our connection with different fintech teams, especially UK and Tel Aviv, Israel. And third, our information from several collaborations we have with the university, with Ferdinando and Bicocca and Bocconi. So going on, first, this is the 4th survey we started last year. I think that usually we got answer from about 1,300 executives and professionals from 10 countries. So we can say it's a global survey. And finally, now we can say that the majority, think that crypto and blockchain can reach a mainstream adoption. Maybe it's a little bit optimistic if we think about blockchain application, but I think that for crypto market could be something real. And this is the first important result. If you think that we got, I think, a good panel of answers. But if we analyze the different areas of a survey, we see that first is for these guys is a strategic priority. Also, this is an important result from the third survey, because you can see that we pass from 50 to 80. That means that executive people with company responsibilities are finally thinking about crypto markets and blockchain. The second is that for the most of these respondents, they see it's a competitive advantage. That means not just application, but also skills and competence on blockchain and crypto markets. The third is the idea that crypto could be an alternative to fiat currencies. This is another interesting information for us. And finally, also the final result is different from the last survey, is that blockchain crypto could be or could impact the value chain of several products and services. Going on the analysis of the survey, we see that the main of respondents see three key factors for change. And I think it's another interesting, and I agree on these 3 points personally. The first is that custody is something different, and is something that is crucial for crypto markets implementation. And we know that the custody of a crypto asset is different from the custody of financial instruments. The second is cybersecurity, because we know that any hacker attack to the crypto wallet or crypto application could get value, and it's really difficult to get back this value. And it's interesting, just to give a curious fact, we saw in August, maybe you can remember, you can already know that there was in DeFi platform that we know is very loved for several people in this room. The DeFi platform was hacked by a guy for 600 million, so an important value. And then there was a sort of agreement between the manager of the Poly network and this hacker, and now this previous hacker is the CIO of the DeFi, the DApp application. It's the strange word around DeFi and blockchain. And finally, we see regulatory barriers. So main respondents say, until we have a clear framework about regulation, we see a sort of resistance to implement blockchain and crypto asset framework. But on the right, you can see also that we see MiCA in Europe could be a sort of a new framework to manage crypto assets, but also we have several sandbox in the UK, in Denmark, in Netherlands, some of the countries, and maybe in Italy now. I don't know if there are any other upcoming news, but in November, so now, we should understand better the sandbox also in Italy. I think it's something important and interesting for all of us. Just 2-3 numbers from fintech team in Deloitte, and I think that the most important figure in this slide is the amount of billion spent, invested in blockchain and crypto company in the first 2 quarters of this year, 2021. And we see it's about 10 billion of, you see the last quarter is more than 4 billion. So we see that there is a sharp increase of investment in blockchain, and it's coherent with the survey results. And on the right, we also show the main deals we have seen in the second quarter of this year. I think that you know, they are all important and all the result of strategic impact of blockchain and crypto assets. The last source from our partnership with university, lab, and research teams, just to repeat, the total value of the crypto world, as you know, is more than 2,000 billion. Again, Bitcoin is the main crypto asset. Then we see Ethereum and all the others. And just to remember how Bitcoin and Ethereum are for sure the most important crypto asset now in these days. And then the DeFi and apps ecosystem, just 3 numbers. I think it's they are interesting. The first is about 8,000 of decentralized application. On the right, we see about 2.5, 2.6 daily users, million. And finally, the asset locked in DeFi application, about 170 billion. I think also these numbers represent the importance of DeFi and crypto asset in this world. And also we see the most important decentralized application, Curve, Compound, Pancake, and Uniswap. And I repeat in several workshops and events that Uniswap is about 600 code lines, and it is worth more than 500 million, if I remember. So it's an interesting and curious situation we see in the crypto asset and decentralized application. But this, after this short description of what we see in the crypto asset world, I again want to be concrete, and we see at the end today we see 3 main businesses that are offering crypto asset and ancillary services like trading, custody, and advanced trading. Second, offering financial instruments with underlying crypto assets. And finally, offering crypto payments process services. So if I come back to the main results of the survey, when we see that the most of the respondents say strategic application, strategic impact, at the end today, I think that we can discuss about these 3 main businesses. And so what they mean? First, the crypto asset trading is very common in the financial services, so the value chain is almost the same of other platform to trade in the financial services. Just to remember that custody, even if it's a light custody, is something different from the traditional trading venues. Then we have the crypto asset custody, and the crypto asset custody, as I said, when it's not just light, but it's something more strong in terms of features and security, should be managed in a different way, also with an important reporting assets because of regulation or other information we have to manage and to deliver. In final, and for sure, I have I could say that in the last month I got 3 requests from clients to discuss about accepting crypto payments, and not just for micro payments, but also for important payments, not just for buying few value goods. And so I'm studying and analyzing how we can deliver a payment process value chain, considering the specific approach of crypto and also custody, and how we can transform in fiat currency, or to check what we call anti-money laundering or anti-corruption and other regulation when the value is not small. And coming back on the regulation, we remember that the 3 key success factor in our survey are custody, the cybersecurity, and regulation. I think that today we don't have a complete and clear framework to manage all the aspects of crypto management. But in any case, we see MiCA for crypto asset trading, and also MiFID for custody, if we think also about other instruments. And finally, MiCA can again be a support for crypto payment processing. So I think that we can, today, if I think 2 years ago, but today we have more point of references to manage crypto asset implementation. And just to remember that when I say crypto payment processing, I'm not talking about the CBDC, for sure. That is another process. So what? The conclusion of our analysis and presentation. What we can say today to the financial institution that are the main supporter and the most important companies that have the possibility to implement the crypto asset services and products. First, don't be shy, because now we have a lot of information, we have some point of references, and so I think that they should explore crypto asset services, and I think that they have to do that. Otherwise, other company can get their positions. I remember that the financial institution have a lot of competence on a lot of aspects of implementation of a crypto asset. The second takeaway is that you need to have a lot of connection with the ecosystem, because you can't implement in the best way crypto asset and blockchain application without getting the best skills and competence. So this is for all people, for all operators, also for consulting firm, institutional firm, because we need to cooperate and to collaborate because of the complexity of this field. The third point is having an open platform. We have had a lot of discussion in the last 5 years about open platform, open banking, but what I'm saying is not just the technology aspect of open platform. It's not just an issue of integration with API. It's also a sort of new approach to be open in terms of processes, in terms of managing of a partnership that are not poor outsourcers. They are partners. You have to manage the clients with other partners. So it is a new concept of collaboration. And finally, I think that one of the first discussion about crypto asset that is anti-money laundering, the use in the criminal situation, I think that and we should say clearly that crypto assets are more we can control more crypto asset than all the other traditional payments or fiat currencies. These are for us our 4 takeaway, and I hope that I was clear. And if I don't know if there are any questions, I'm here for the questions. Thank you very much.
Thank you, Paolo. And yeah, I will go first. I mean, I've been following the Deloitte's blockchain survey. It's quite a few years now. And it's impressive because at the beginning, I mean, this was a blockchain survey, and the focus was on blockchain, 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 not crypto asset. And as some of the people present here know, that when we started the Crypto Asset Lab 3 years ago, there were people suggesting that we were just another blockchain lab or blockchain observatory or something like that. Today, looking at the most recent survey, it seems like the whole consulting and financial world has switched off. So they are not waiting for a blockchain solution for finance, but they are providing or intend to provide financial solution for the blockchain economy of crypto assets. This looks pretty impressive. Don't you agree on that?
Yeah, I agree completely because after several years of studies and projects, I think that it's clear that crypto asset is something concrete and we can do business with crypto asset. I think that we can say that blockchain as a technology will not impact internet. This is my idea. Maybe there will be a moment in which we will see in internet a sort of a blockchain layer, but this is something that we don't see today. So to be pragmatic, focus on crypto asset and try to get the best services and products on crypto asset. This is the final message from the survey.
Are there other questions from the floor or from remote? No? Okay, so since we are kind of running late, and thank you again, Paolo,
thank you
for your contribution and for Deloitte, having Deloitte sponsoring the conference. And this is the time for a short break. Let's say that we resume the conference at 20 minutes past 5, okay? So 10 minutes break, okay? Thank you very much. Okay, so we are almost ready to start. No, I don't think so. Okay, so Monica Rossolini is the next speaker, so if she could get ready and the behind the scenes stuff can get her on the screen. Okay, I will leave the floor to Gianna Figata-Talamanca. She's going to moderate the fungible and non-fungible tokens stream. Thank you, Gianna.
This one, okay, thank you. So I'm very happy to be here moderating this session on fungible and non-fungible tokens. And once again, we have to thank our sponsors, so the gold sponsors, CheckSig and Deloitte, and the silver sponsor, Elidata. And so we can start with Monica Rossolini. She's talking about a topic modeling analysis of white papers in security token offerings. Which topic matters for funds? So I think, Monica, if you are there, the floor is yours.
Yes, good afternoon. Do you hear me?
Yes, more or less, yeah.
Okay.
And we see you.
Okay. I have not the possibility to share my screen, so I ask for the staff if it's possible.
It will allow a few seconds.
Okay, yes.
So
now,
Monica is requesting the ability to share the screen.
Okay. Now do you
Yes,
see
we
my
see,
screen?
yes. Perfect.
Okay, perfect. Thank you very much. I would like to thank the organizer for the opportunity to present this paper. And I would like also to say to all the participants that comments, suggestions are very, very welcomed. As the title states, this paper focused on security token offerings, so digital assets that have the potential to become an inclusive means of raising capital for small and medium-sized enterprises. These type of instruments are based on a direct peer-to-peer mechanism that enables an entrepreneurial project to raise funds in exchange for cryptographically secure tokens issued on a DLT system that can be publicly traded. So since STO's investors purchase security tokens that share future earnings,
I don't know if people from remote was damaged too by this attack. And anyway, Monica, are you still with us?
Yes, I'm here.
Okay, Monica, I'm sorry, but this is, somebody is trying to. It took this as a very vocal appreciation or applause for your work. Okay, and go on. Thank you.
Okay, thank you. I'm saying that this paper focused on STO, so security token offerings, that, as I said, is a sort of financial instruments. And for this reason, also the information that the issuer disclosed to the investor is very important. the instrument to disclose this information is represented by the white papers. So these are the reasons why we focus on security token offerings and on the content of the white papers. I realized this paper with some co-authors, Paolo Bongini from the University of Milan Bicocca, Francesco Osborne, the Open University, and Alessia Pedrazzoli from the University of Modena and Reggio Emilia. After this introduction, I present you the main goal of our paper. The goal is to investigate the relevance of the topic and content in the white papers and the impact of this content on the campaign success. So since we are talking about financial instruments, and so as I said, the asymmetric information is very important, we think that it's very important to analyze in detail the content and the structure of the white paper and verify if this content could affect the success of the operation. So in the paper, we address three main research questions. The first one is which topics characterize STO white paper. Then we try to verify which of these topics are able to impact campaign success with a specific focus on two main types of information: technological disclosure and environmental disclosure. We collected data about 188 STOs from 2017 to 2021. Here we have some information about the method, but then I present this information more in detail. And the result in a nutshell, we define 9 different topics. One of the main important topics is energy use and green aspects. And the two topics that seem to affect the probability of success are technology applied in healthcare sector and, once again, the energy use and green aspects. But let me present the motivation behind this study. The STOs is a market, is a relevant market that is growing a lot. Why? Because the higher investor protection in STOs compared, for example, to initial coin offerings has increased the expectation for the growth of this market in the future. Some study, a certain amount of study exists for ICOs, but only few studies focus on security token offerings. We detect 4 studies, as 2 of them have been published in 2021. We based on the literature on ICOs for developing some hypotheses also regarding the study of security token offerings. As I said, since we are talking about financial instruments, the white paper is an important instrument to reduce information asymmetry with investors. Like in the IPOs, when we have a prospectus, in the STOs, the white paper is an informative means to attract prospective investor interest, communicate the issuer's quality, and support the liquidity of the market. The role of the white paper in campaign success have been studied in ICOs literature, and different studies demonstrated a positive impact of the white paper on the campaign performance. Since the white paper is not mandatory, and there is not a mandatory format, a mandatory structure for the white paper, differently from what happened for the IPO prospectus, it's very important also analyze the content of the white paper and the structure. So the third column of these slides represents the white paper disclosure. We analyze the structure, so readability, length, as in the previous literature about ICOs. Language style is another important element that can be analyzed, and the quality. The quality that is expressed as the number of technical words or the presence of specific section. So we based on this literature related to ICO to develop our study that focus on STOs. Literature about ICOs, we found some important information regarding which are the main information that should be disclosed to the investors. And we detected 2 main groups of information: technology disclosure, and energy and environmental disclosure. Regarding the first one, the technological components of the project and their application in the business proposed are crucial factor in the evaluation of the company. And technological disclosure is considered effective in reducing information asymmetry between investor and entrepreneurs. So we focus our attention also about these aspects. And the second one is the energy and environmental disclosure that can concern the energy consumption of technology that can be different based on different technology use and different choices and design of the project, but also some specific projects that address energy issue or climate change or some of these aspects. So let me present briefly our sample. We collect our sample of STOs that, as I said, is composed by 188 STOs in the period 2017-2021 on the basis of different STOs aggregators that we mentioned in this slide. The 53% of these STOs belong to extra-European countries, and in this chart we represent the distribution by sectors. The 35% belong to financial sectors. Then we have 33 manufacturers and 17 to the services sectors. We have, as I said before, we have three main research questions. The first one regards the analysis of the topics represented in the white papers. So we use a methodology that is able to define groups of words, and so the main topics represented in the white paper. This methodology is the LDA, latent direct allocation. This is a Bayesian topic modeling that fully automates the process of producing a probability distribution of the topics in a corpus. Similar to cluster analysis or factor analysis, LDAs uses statistical association of words to generate latent thematic structure within a large amount of text. So these latent topics are clusters of back of words that jointly represent a theme in the text that emerge without the aid of predefined explicit dictionaries or interpretative rules. So one of the main advantages of LDA is that it does not impose on the researcher dictionary or interpretative restriction. It relies on the fact that words frequently appearing together tend to be semantically related. To identify the number of topics, we refer to a metric that is the topic coherence, a standard metric that measures the degree of semantic similarity between high-scoring terms in each topic. And we define 9 topics. We try to apply this methodology with different level of K, so different number of possible number of topics, from 5 to 15, but then using the topic coherence and another parameter that is the interpretability of the results, we detect a number of 9 topics. These 9 topics are represented by bubble that you can see in this chart. For each bubble, we have a number of words with a weight for each word that represent how much this word is present in the topic. Here you can find our groups, topic 1 from 9, and the top 7 terms for each group. Based on the terms and referring also to previous study, we generate some interpretive labels. So for example, for the first group, the label is energy and green issues, and here we have the 7 top terms: energy, green, mining, electricity production, and so on. Then we have the second topic, so the second group of work, company description, the third, artificial intelligence and machine learning, the first, IT for art and education, then DLT component, the 6th, IT for construction and manufacturing, IT for healthcare, then financial and legal issues, and the last, IT for financial and other services. You can see the different topic and the different bubble. The size of the bubble represents how much this topic is present in the white paper. The larger bubble is IT for financial and other services, but the second one is IT, is the energy and green issues. It is the topic number one, so energy and green issues. This, and then you have the other bubble that represents other topics. Here you have another representation, is an histogram. Then you have the number of white paper that present a certain percentage of the topic. The blue bar represents the number of white paper where the topic is present at least 10%. In the orange bar, 30%, gray bar, 50%, yellow bar, 80%. So you we can confirm that the financial and other services is the topics more represented in the white paper, but the second one, once again, is the energy and green issues. And so you can see the other topics. So this is the first the results of the first part of our paper. Which are the topics that are presented in the content of the white papers? And we can see that the energy and green issues is one of the most represented. The first one is IT, the technology applied to financial and other services. Then the second part of our paper aims to answer to the second question: which of these topics are relevant in influencing the campaign success? We ran different models. Our dependent variable is the variable success that we create as a dummy variable equal 1 if the total fundraise is greater than the minimum target, or the STO has raised any capital in case no minimum target requirement is specified, and 0 otherwise. So success or unsuccess. Then we made some robustness, changing our dependent variables from this dummy variable to the total amount raised, the logarithm of the total amount raised. Our independent variable are the topics. So we have the percentage of words in the document relative to a specific topic, relative to the topic that we detect with the first part of our paper. And we try also to consider another measure of for this topic. So we create a dummy variable for each of these topics, equal 1 when the topic is present at least 30% in the text. So we define this threshold of 30%, but we try also with different threshold, 10% and 50%, but the results do not change. Then we have some control variables, so the length, the number of words, the size of the document in byte, the presence of extra documents, so the number of files attached to the white paper, picture and tables, so the visual cues. Some control variable offering days, pre-sales, soft cap use, so the presence of a minimum target requirements, and then fixed effects for time, sector, and country. So with this part, length, size, and extra document, picture, and table, we try to control for readability and structure of the white paper. Here we have our two models. So we applied a probit model for the when our dependent variable is the dummy success and success, and a probit model with amount when the dependent variable is the amount raised. Our results. So here you have the results of our main model. Please focus on the third and fourth column, because in the first one we analyzed, in the first and second, we had coefficients and margins only when we analyzed the readability and structure of the white paper, and then in the third and fourth, we have coefficients and margins when we had to our analysis also the topics. The first and fourth column, sorry, because I have a WebEx bar that cover is model 2. We have the topic represented with the percentage that appears from the LDA, without constraint, without threshold. In this case, we see that the topics able to affect the campaign success is only the IT, the technology applied to healthcare. So how are the group number 7? The disclosure of information relative to technology IT applied to healthcare generate a relevant impact, positive impact on the success. Regarding the readability and structure, we can see that the size of the white paper negatively affect the probability of success. So heavy documents negatively affect the success, but the presence of extra files, extra documents, positively affect the probability of campaign success. If we change the measure of the topic, so we consider a threshold, so we consider the topic as a dummy equal 1 only if this topic is as a presence of in the white paper of at least 30%. Also, the energy and green issues has a positive impact on the campaign performance. So you have to disclose information about energy and green issues, but at least for a 30% of your total words. As I said before, the same results is achieved considering a threshold of 10%. We make some robustness. So in the first, in the model number 4, we had soft cap use, pre-say soft cap use, sorry, and this variable is significant. And the presence of a soft cap use, the presence of a soft cap, so a minimum requirement, positively affects the campaign success. Whereas we do not find positive or significant relationship between the pre-sale dummy offering days and the success. The last model, the model number 5 and 6, we change our dependent variable. This is robustness. So we use the amount raised. We change also our model. So in this case, we applied a Tobit model. And in this case, we can see that when we consider the topic as appears from the LD8, so without constraint on the percentage, only the IT for healthcare appears significant. You can see here. When we consider the constraint, so the dummy, the topic is equal 1 if the number of words is at least 30% in the white paper. Also, the energy and green issues appear as significant in influencing the campaign success, so the amount raised in this case. So our results are confirmed. So let me conclude with some key points and some conclusion. Energy and green issue is one of the most represented topic in white paper. The first is the IT, the technology in financial services and other services, but the second one is energy and green issue. We find also that the technological components of the healthcare sector and the disclosure about energy and green issues are hot topics for campaign success. Regarding the readability and structure, we can assume that EV documents negatively affect the success, whereas light documents with some extra documents, extra files seem to be more effective. We can conclude that in STO markets, megatrends, and in particular aging, health, and climate change, seem to be relevant also for the investor. The leading role of technological and ideological motives for investor in token offerings are confirmed by the type of information they look at. And we can give an insight into disclosure in digital context. So in terms of revision of standard prospective content, we suggest to give inadequate space to technological and to the environmental part of the document. Regarding limits and future developments, we have a relatively short and small sample period, and so a small sample of STO, even if it is in line with other studies in this context. Future research could extend the observation period and consequently the sample dimension. regulators are developing specific disclosure requirements for STOs. So the question is, how does regulation change disclosure and white paper structure in STO? So we will work on this. Thank you for your attention.
Thank you, Monica, and a very interesting presentation. So let me ask if there are questions from the floor or maybe online presence. No, I don't think so. So I just want to know, I think you said something at the very beginning. So why are you choosing STO specifically? So do you think this result can be somehow found also for more general ICOs, or is specific to STOs?
Oh, yes. No, we think that regarding digital assets, we made a lot of comparison between STOs and ICOs because, as I said, more studies are available on STOs, and so we applied some of these findings to build the structure of our studies. But we think that STOs are completely different from ICOs, and so this study is not applicable also to ICOs, and are different also from traditional financial instruments. So for this reason, we think that the results can be considered interesting and particular in this field.
And then if I may, I have something which is more a comment, maybe a suggestion. So I've seen that you have taken the STOs from many, let's say, platforms, and I've been somehow looking sometimes at ICO Bench. So I know that they have two kinds of also ratings, which are the bot rating, which takes into account the characteristics of the white paper. So somehow you have that as a control. But it would be interesting maybe to see if the topics are also related to the expert evaluation. So see if they are somehow affected by, because in principle they should read the material. So this would be something maybe interesting to investigate as a side analysis. Yeah, maybe. Okay. Are there any?
Thank you very much.
Yeah. Other questions? No. Okay. So thank you, Monica. Oh, sorry. I'm so sorry. So there's one question over there, maybe.
Yes.
There is another question, sorry. So
just a quick question. You may have mentioned that during the talk, and I might have missed it. So you have you model the probability of success with a binary variable and the amount raised. Do you also look at kind of like the percentage raised of the funding goal? One concern I have is that in the venture capital literature, sometimes it's seen as problematic if you raise like too much money. No, that might not translate well to security token offerings, but still there is this concern. So there might be even non-linearities in the like economic consequences of what you raise. So maybe that would also be interesting, not just the probability, but also like overshooting, for example.
Yes. This is, thank you for this comment. Yes, it's another robustness that we have to do. Until now, we made STO success and the amount raised, but following the literature, another possible analysis is consider the amount raised over the target, and so or the soft cap. So thank you very much. Certainly, we will do this in the future.
Okay, thank you. So we may go to the second speaker of the session, which is Andrea Canidio. Andrea, are you there?
Yes, I'm here. Can you hear me?
Yes, perfectly. Yes.
Okay. So first of all, let me apologize. I'm connecting with my phone because there was a technical glitch with my computer, and I think Lucia has my slides
so
because I don't think I can share slides with my phone. So anyway, as a way of introduction,
are you going to share the slides? Okay.
The majority of the paper, or I think all the paper presented in this conference, which were all super interesting, had a very positive angle, meaning very positive in the sense there is a phenomenon out there. Could be an STO, could be how certain decentralized market operates, and we study those phenomena. And I'm going to switch to something different, something very theoretical and a bit abstract. And the question here is going to be, do tokens matter at all in micro theory in a very fundamental sense? Okay. So as a as a way of introduction, which can you please put next slide? Yeah, so one of the things that blockchain allows to do is to create new digital currencies, new decentralized digital currencies. Thanks to blockchain, I could create my own token, my own currency, a fungible token, so really a currency. The bakery down the road could create their own tokens. This can be done at no cost. And essentially, this is for two reasons. First of all, blockchain allows the creator of this currency to commit to a given monetary policy, essentially whether this token, the total supply of this token grows over time or shrinks over time, and depending on some event, can be all pre-specified in the smart contract that is used to create the token in the first place. Anybody can actually check the smart contract to see what the monetary policy is. And on top of that, blockchain also provides the infrastructure for exchanging this token almost instantaneously, and let's say at almost no cost. And this implies that whereas the creation of new currency is not a new topic, but before blockchain, it was a topic that was studied in macroeconomics. Okay, it could only be studied at the level of a country or a group of countries, because to get commitment to a given monetary policy, you needed perhaps a specific institution, a central bank, and to be able to exchange electronically this currency, well, you needed expensive infrastructure, and this was possible only at the aggregate level. Okay, so the point is that thanks to blockchain, we can study the creation of currency also at the microeconomic level. Can you put the next? Thank you. Meaning for for the problem, we can study whether it's relevant for firms, we can study whether it's relevant for entrepreneurs, we can study whether this is relevant for sellers. Okay. Lucia, can you move forward? Again. Okay. So, and therefore, one of the most fundamental questions one can ask is whether, when I'm selling an object, the possibility for me to also create a token matters or not. And I want to ask this question by considering a repeated auction, okay, in which a seller will need to sell multiple objects over multiple periods. For the moment, let's think of this period as finite. I'll, in an extension, also look at the infinite horizon case. And it's one object per period, okay? Because the willingness to pay of the buyers is unknown, it turns out that the revenue maximizing mechanism to sell this object is an auction, okay? And therefore, like standard in this literature, there is this auctioneer who will have to choose which auction format to use, first price auction, second price auction, or all pay auction, so there are many. But specifically here, it will also choose whether to accept payments in fiat currency, let's say dollars, or instead accept payment in a new token that he will create at the beginning of the game, and that initially he will own the entire stock of this token. And at the creation of this token, the auctioneer can also specify monetary policies. So how this token, grows, the stock grows or shrinks over time. So, and in a sense, it's already something interesting here. The monetary policy can be thought of a part of the auction format. Lucia, can we go forward? So in writing down the model, which for the sake of time, I won't show you, I'll just describe and then describe the results. Anyway, in this model, the key assumption has to do with how you want to think about a token. And essentially, in the model, the token is going to be somewhat inconvenient in the following sense that there is a market for token that allows you to exchange tokens for fiat currency and vice versa, which opens once in every period. So if you receive payments in tokens, depending on when you receive these tokens, you might need to wait one additional period in order to turn it into fiat currency and then consumption. So in some sense, tokens are somewhat inconvenient. On the other hand, token is a new financial asset, and it will be bought by risk-neutral bidders who will purchase them either for paying the object, so essentially participating to the auction, or for speculative reasons. They may also buy tokens because they expect the future price of token to be higher, and hence buy token, not use them in the auction, and then sell them in the later period. And so there is this additional element that comes in when you use tokens. Now, it's also, I think, necessary here to think carefully about how to model fiat currency, dollars. And here, most of the literature has taken a very stylized view, including myself in previous paper, of dollars or fiat currency, in a sense that it's typically assumed in those models that you earn fiat currency and this translates immediately into consumption and utility. Okay, it's as if you can eat the dollar directly. And so this is basically the maximum difference with the token. Token, you need to wait sometimes to exchange it. Fiat currency, you just eat it. Well, this will be the benchmark case also in what I'm going to show you today, but one can think of a more nuanced view, because we all know from previous literature, not on cryptocurrency, just on currency, that people oftentimes need to accumulate cash before they can go out and spend it. This would be the cash in model with cash in advance constraint, in which there is a market that opens at certain moments in the period in which people can exchange fiat currency for consumption. And so also there it matters because you may earn fiat currency dollars in a certain moment and need to wait a bit before turning into consumption. Okay, this is a more nuanced view that I will also consider and discuss here. Can we go forward? Okay, this I said it already. Next slide. Okay, so let me jump to the results. Okay, without showing you the formal model. Now, in this very simple benchmark case, in this finitely repeated auction, I can show that the revenue equivalence theorem holds, in a sense that the present discounted value of the expected revenues are the same with or without token. However, the auction with token or without tokens are different in the time profile and the variability of those revenues. So what is happening here? If I run my auction using dollar, the auctioneer every period is going to receive some revenues, which are stochastic because the buyers are drawing valuation in every period. And it may be that one period they draw high valuation and therefore the auctioneer is making a lot of money. It could be that the next period they draw low valuation and the auctioneer is making not a lot of money. So in the auction with dollar, there is every period some revenues which are stochastic. Now, in the auction with tokens, things are a little bit different because of the presence of speculators. And in fact, when the valuations are low, people will not demand tokens, that many tokens for participating in the auction, but the expectation is that the valuation will be higher in the future. So here is where speculators will kick in and start buying tokens. So the presence of speculator boosts the auctioneer revenue in a given period. However, when the following period arrives, now the auctioneer is effectively competing with the speculators on the market for tokens. So the speculators essentially, and therefore reducing the revenues of the auctioneer in that period. Now one can show that these two effects perfectly offset. However, in a sense that the loss in one period equal the gain in the other period, but it is, however, true that doing this, the speculator end up front-loading the auctioneer revenue. In addition to that, the speculators, since are risk neutral, they behave looking at the expected future value of this revenue of the price of token, and therefore they end up absorbing some of the risk that will otherwise to which the auctioneer will otherwise be exposed. And so front-loading of revenues and reducing the variability of revenue. There is an interesting special case, with a special case in the sense with a specific monetary policy, which is where the auctioneer announces that all the tokens that will be used for paying him in the future will be burned. So essentially the auctioneer sells his initial stock of token and then says, you need to use the token to pay the object. However, every time you use the token to pay the object, I then going to burn the tokens. In this case, what happened is that the auctioneer is going to earn the present discounted value of the expected revenues in the first period and with probability 1. So essentially, the auctioneer is able to fully front load those revenues and fully de-risk those revenues. And when is this relevant? Well, it's relevant if the auctioneer is risk averse and there is no insurance market out there. So, and the auctioneer is not able to insure against these idiosyncratic shocks that he's facing. And or if there are borrowing constraints. And here the logic is a bit subtle, but the point is that in the auction with token, the auctioneer is earning all the revenues in period 1. So then he can achieve the optimal consumption smoothing simply by saving in an appropriate way. In the auction with tokens, if he's earning revenues in every period, optimal consumption smoothing may require him to borrow in certain periods. But then if there are borrowing constraints, he might not be able to do so. So if there are borrowing constraints and if he is risk averse and there is no insurance market, then this auction with token is strictly preferred to the auction without token. Can we go to the next slide? This is the benchmark case where I said you receive fiat currency, you eat it. And this gives you utility. Now, in the cash in advance case, cash in advance model are very sensitive to precisely how you model what happened within a period. When does the market that on which you can exchange fiat currency for consumption good open, so on and so forth. However, it is usually the case that earlier revenues are better. So if you earn revenues earlier, you are more likely to be able to spend them within the period. If you earn your revenues later, well, depending on when exactly the market is open, you may need to wait one more period to spend this money and consume. And the point is that the auction with token here is beneficial because it allows the auctioneer to anticipate where he earns revenue. In the auction without token, the auctioneer has to get the object, then run the auction, and then collects the revenues. In the auction with token, he first sells the token, then he gets the object, and then he auctions it out and receives the payment in tokens. So revenues are earlier, and so now expected revenue, when you measure it in consumption, in realized consumption, are greater in the auction with token than the auction without token. So here is another. So even if you're risk averse, and here you prefer the auction without tokens to the auction. So you prefer the auction with tokens than the auction without tokens. Lucia, can you go forward? There are two extensions that I'm going to discuss. By the way, this is not in the paper that is up on the website, unfortunately, it's because I still didn't have time to type it up. But the first obvious extension is to look at what happened in an infinite horizon, infinitely repeated auction. So as it's usually the case, it's going to be a model with multiple equilibria, because again, this is about money, there is infinite horizon, and therefore, if people expect the speculative demand for tokens to be high in the future, it will also be high today, driving up the price of this token. If people expect the speculative demand for tokens to be low in the future, it will also be low today, therefore lowering the price of token today. What is interesting is that this does not necessarily, it's how this multiplicity of the equilibrium translates into the expected revenues. And the result is the following. If the monetary policy is when the auctioneer runs an auction with tokens, the monetary policy is such that he always expects to receive some tokens and then sell them back, the auctioneer revenues are all the same in all of these equilibria. And the intuition is again the same. Yes, there are equilibria in which the speculative demand for token is high, meaning that the instantaneous payoff of the auctioneer is larger, but then these speculators are competing with him in the future, lowering his future revenues. On net, his revenue are always the same. This logic breaks down when, the auctioneer commits to burning all the tokens he received as payments in the future. In that case, revenues are sensitive to the presence of these speculators. And in fact, you can show that now the equilibrium revenues are a set because there are multiple equilibria, which translate into multiple possible revenues earned by the auctioneer. And these are, in general, the set is larger in a set sense than what he can earn by running an auction without tokens. Next slide. So the final extension, final result, which I think interesting, is to look at what happened in a double auction. Essentially, the auctioneer sits in the middle, collects bid from buyers, and then bid from possible sellers and then essentially enables the trade. Now, these models have a host of issues with respect to existence of efficient mechanisms that allow trades. One can make sufficient assumptions so that those issues don't arise, which is what I do here. And if you do, you can show a few interesting things. Okay, the first one is that this double auction with token can exist only if the horizon is infinite. There is no double auction with token in a finite horizon. That's because at the end, in the finite horizon, last period, you will need to pay the seller with tokens, but which at that point are worthless because then the game ends. So you cannot do it. Then in an infinite horizon, some of the results I described earlier still continue to hold. There are multiple equilibria. And again, if the auctioneer expects to receive tokens and then use them to, then sell them in every period, despite the fact that there are multiple equilibria, his revenues are all the same and are equal to the revenue he will earn if he was to run an auction without token. However, again, if the auctioneer commits never to sell any token in the future, then he may earn higher revenues than in the auction without tokens. What is interesting here is that he can commit not to sell any tokens in the future, for example, by always forwarding all the tokens received from the buyer to the seller. So essentially, he's just transferring all the money, all the tokens received to one side of the market to the other side of the market, which looks very similar to the centralized digital platform, in which the creator essentially sells the initial stock of token and then enables this trade without ever taking a cut. Okay, Ethereum works this way. The vast majority of them work, and it's nice, therefore, to recover this mechanism in this more theoretical environment. Lucia. Yes, so I think I've run out of time. Obviously, this is related to many things. There is a large literature in mechanism design studying implementation theory and showing that tokens can play a role, but this literature has looked as aggregates economies. So again, obviously the fact that blockchain is relevant for mechanism design and implementation was noted before, but this has always been in the sense of using smart contract to create commitment. So different discussion here. And the literature on token of ICO, to which I've contributed in earlier paper, is somewhat related because, again, in this paper, I show you that the auctioneer can front load all the revenues and de-risk those revenue. And obviously the follow-up question will be, okay, but what if those revenues need to be used for financing the creation of the object that then is sold, so on and so forth. So that therefore then will bring this paper very close to this other paper who has studied EICO, who really have all of these features. And that's it.
Okay, thank you, Andrea. Are there any questions from the audience here, or maybe from remote attenders?
Of course, they don't hold if it's non-fungible. How can you this mechanism that are actually non-fungible?
So whether this mechanism will work also with non-fungible token, is this the question?
Yes.
I don't think so. I don't know. I don't think so. I mean, first of all, it's not clear in what sense tokens will be non-fungible, because what will they represent? But the research question is really about fungible tokens, so the creation of a new currency. If it's not fungible, it's not a currency.
Okay, are there other questions? Okay, I think we can move to the next presentation. Thank you, Andrea. And it's on non-fungible tokens, markets, so on Ethereum blockchain, development, conjugation, and interrelations. And the speaker is Lennart Ante. Lennart, are you there?
Yes, I'm here.
Okay.
Can you hear me?
Yes, we can hear you. So please share your slides and the floor is yours.
Thank you very much. Okay, Hi everyone, and thanks a lot for having me here, to providing me with the option to present my work. My name is Lennart Ante, and as I was just introduced, I'm presenting a paper on non-fungible token markets. Non-fungible tokens are essentially some sort of tokens that are smart contracts on blockchains that represent unique items and that are, as the name states, non-fungible. So they can be digital assets, something like a digital picture, a simple JPEG, or they can also be real-world assets, such as a physical piece of art that is in a museum but is then being represented in such a blockchain-based token. And each NFT is a unique value that cannot be replaced by any different NFT. So if we look at fungible values, one Bitcoin is fully interchangeable with another Bitcoin in theory. Obviously, one Bitcoin could have some money laundering aspects and stuff like that, then it wouldn't be fully interchangeable, but in general it is. And NFTs may represent very similar aspects, such as two NFTs that represent a trading card of LeBron James, and that look exactly the same, but they will always be uniques, as they have unique identifiers. So I think that's a good explanation on how NFTs will always be unique. NFT markets have experienced exponential growth in the last year, or rather this year. And an example is the OpenSea digital marketplace on the Ethereum blockchain, where you can see the monthly traded volume in US dollars on the right-hand side. And you can see that from, I think, August 2021, the market was just exploding. And in the last month, we had over $2.6 billion traded. We had 1.4 million NFTs sold, and all time with over 600,000 users that traded or held NFTs. So obviously NFTs are quite a relevant and growing phenomenon. And by now we have numerous high profile cases. So on the right-hand side here, you can see that artists such as Beeple sold a single NFT for $69 million, or Quentin Tarantino will sell NFTs that represent clips from the Pulp Fiction movies. McDonald's is going to issue NFTs that somehow relate to their McRib, and Twitter is working on allowing users to showcase their NFTs, especially because on Twitter there's a phenomenon that users started putting NFT pictures as their avatars. So firms are adopting NFTs as part of their strategic management. Celebrities and artists use them to monetize content, to interact with their communities, and the whole market is simply growing and seeing adoption. But however, the phenomenon is still largely unexplored. So from a financial perspective, there are a couple of articles that focus on how NFTs relate to cryptocurrency markets. So how is Bitcoin or Ethereum relating to the NFT markets? And 6 days ago, there was another article published in Finance Research Letters that shows how NFTs, that shows spillover effects between NFTs and other asset classes. But a part of that, there is very, very low research and simple scientific knowledge of the whole ecosystem by now. So the research questions that I look at in my article is, how do NFT markets, or rather sub-markets, causally relate to each other? And in the whole ecosystem, we have lots of different stakeholders that have a different need for managing their risk and understanding the markets. We have NFT owners that simply want to possess NFTs or want to trade them. We have issuers such as previously mentioned McDonald's or Quentin Tarantino's. We have intermediaries that offer platforms such as OpenSea, where you can trade or issue these tokens. And we have base layer infrastructures such as the Ethereum blockchain or Near blockchain that provide underlying technology, and it brings value to the respective blockchain infrastructure. And NFTs focus on very different application areas: art, gaming, collectible, metaverses, and all types of stuff. And as we can see, is the very first projects that are, for example, CryptoPunks, were rather unsuccessful for a very long time, but now that NFT markets pick it up, they are being revived, and by now CryptoPunks are being traded for millions of dollars. So there can be an assumption that the overall growth and success of other NFT markets influenced older projects and revived them. So the question is, how did the field evolve over time? And if some economic variables, such as sales, trading volumes, or users of one NFT project relates to the ones of the other projects, this could have quite some implications for strategic management, for strategic decisions, how to invest, how to enter a market, how to collaborate with potential competitors. So the goal is to gain an overall understanding of the market, and especially doing so by analyzing causal relationships between NFT submarkets. And to do so, I obtained data from Non-Fungible, one of the leading data sources on NFTs on the Ethereum blockchain. And obviously there's a huge amount of data. So my focus was on the largest, most relevant markets. And that's obviously also a limitation, because I said that an NFT project, the platform, needed at least $10 million in traded volume as of May 2021 to qualify to be in the analyses, and that led to 14 different NFT projects that fitted this criteria. And for all of these 14 projects, I extracted the daily macro data that are the number of NFT sales. So how often are NFTs of this platform or project being sold? How much money is being spent or traded regarding these sales? And how many unique blockchain wallets are involved in all these trades, which can be a proxy for the actual users that apply or that are in such an NFT market. And the goal is to first provide a description, summary, and visualization of the NFT market to gain a basic understanding of its scope. And next, analyze the short-term and long-term interactions, as well as causal relationships between all these projects. And to do so, I apply a vector error correction model to first calculate short-term Granger causalities, and afterwards visualize their long-run and short-run relationships via impulse response functions. So now we come to some results. These are descriptives, and we can see that NFT projects show very different patterns. So here I only extracted data for 6 of the 14 different projects that I looked at, simply because of spacing and to keep it brief. So these are the 6 oldest ones, with CryptoPunks existing since over 1,400 days and CryptoVoxels for over 1,000 days. And we can see that CryptoPunks has on average 9.4 sales per day, while the project CryptoKitties has over 2,200. Similarly, the mean of CryptoPunks regarding trading volume is 236,000, while XC Infinity, another project, only has 17,000. So there are obviously different use cases, sectors, and characteristics that have quite a high relevance regarding these descriptives and metrics, and that may relate to the sectors that are also listed on the right-hand side. So CryptoPunks are collectibles, while, for example, Decentraland is a metaverse application, and they're quite different, although they both issue NFTs. So this is more or less the temporal evolution of the NFT market in 4 different graphs. So on the top left side, we can see a simple graph of the number of transactions split down to these 14 different projects and all others. And we can see that the CryptoKitty project had the vast majority of all transactions over time, and in Q4 2017 was actually the top of the market as of my data. Now that it's November 2021, I can say that the actual top was in October, but well, when I started doing that, it looked as if Q4 2017 was the actual top. And if we look at the right-hand side at the bottom, that's quite interesting that we can see the NFT market shares by US dollar volume traded. And on the very, very left side in 2017, we see that all that is being traded is CryptoPunks, so the very first. And then for like 2 years or so, no one really cared about CryptoPunks, and everyone cared only about Decentraland or CryptoKitties, etc. And then in Q2 2020, the whole market picked up the phenomenon of CryptoPunks again. And by Q2 2021, CryptoPunks nearly amounts to half of the whole market, which is quite interesting because that speaks for that it's being revived. And well, the very most obvious chart is on the left bottom side, and that simply shows the transaction volume in millions, not relative as on the right side. And you can see that in 2021, the market experienced very, very explosive growth. So the next step for the empirical model, I first had to specify the time series data. And first, I applied some unit root tests, and this led to me dropping some non-stationary data series. So essentially, I was only able to look at 11 of the projects because 3 of them simply didn't fit, mostly because they were only in existence for a couple of weeks, and the data was simply not suitable for analysis. Then the next step, I tested the series for co-integration, and they are all 3 different macro variables that I identified co-integrated. So therefore, I had to use a vector error correction model to look at short-run relationships because co-integrated series has a long-run equilibrium relationship. So here are short-run Granger causality for the NFT sales for these 11 different projects. And I put a red graph here that shows how Somnium Space is quite interesting because on Somnium Space, Granger causes 6 other projects and is Granger caused by 3 other projects. And being Granger caused means that there's a causal relationship in the time series that is significant in this case, but we cannot say if it's positive or negative. So to look at if it's positive or negative, I visualized impulse response functions in the next step to assess the direction of the short and long run causal relationships. And here I only show the ones for Somnium Space, and in the paper there are many more. And on the left-hand side are the examples where Somnium Space, a metaverse project, is being Granger caused or influenced by other projects. And you can read these graphs as how standard deviation shock will affect the respective project over the course of 30 days. And we can see that increases in the sales of CryptoPunks and art blocks have both a short and long run negative causal effect on Somnium Space, while Decentraland sales positively impact the sales of Somnium Space. That's quite interesting because both of Decentraland and Somnium Space are metaverse projects, while the other ones are, well, art or collectible projects. And on the right-hand side, we can see how Somnium Space itself causes other projects, and we can see that increases in the NFT sales of the Somnium Space project negatively impact sales of the projects CryptoKitties, Axie Infinity, and Art Blocks, while the effects are actually positive for the project CryptoVoxels. And for 2 other projects, the results are mixed, and the long-run relationships are close to 0. So we can see that there's obviously a lot going on, and projects are co-moving and very much causally related to each other. And that actually leads to the conclusion that NFT markets are driven by other NFT markets. And even projects with widely diverging content can have a significant positive or negative impact on each other for various different variables. And that's quite relevant for all involved stakeholders, such as owners, issuers, intermediaries, and infrastructure providers, to simply understand this market. So if I would issue an NFT, I would also have to look at all other projects that are in the market, and my success may not be dependent on how good or how great my art is, but simply how good and great attention on CryptoPunks is if I issue a token that is similar to the ones that CryptoPunk offers. And in summary, the study provides a rather comprehensive overview of the development and interrelation of major NFT markets on Ethereum. And it shows when markets peaked and how the market evolved, or rather experienced explosive growth in 2021. And we can see that metrics are highly dependent on the underlying use cases. And one thing we always need to keep in mind when talking about NFTs is that there's still a lot of shortcomings and uncertainties, such as wash trading, where you don't know how much of the actual trading volume in the market is real, or how much is being wash traded, if there's legal certainty, if there are copyright issues, etc. And I think we will hear about specifically the legal certainty part and the copyright part in a following talk. So thank you very much. That's my presentation.
Okay, thank you, Lennart. So for your interesting presentation, are there questions here in the audience?
I have one.
Yes.
So please.
Okay.
Ferdinando here. Yeah.
Lennart, I love this quantitative approach to NFT. So don't take this as a criticism, but I want to know your opinion. So it seems like the artistic value of the NFT per se plays almost no role in your analysis. Is this something that is done on purpose? Do you think that there is no artistic value to be involved in that market, or what else?
Well, I believe that we see some, well, the NFT market has some indications that there might be a bubble. And I don't know, but it reminds me of the ICO market. And obviously there's a lot of stuff that is a lot of innovative approaches in the NFT market, just as it was in the ICO market. But I simply don't believe that the artistic value is as high as the monetary value of all of these NFTs that are being traded. And I think it's a speculative market, and I believe that this market will cool down in the future, and after that it will then again grow and hopefully become a little more qualitative. But just a feeling.
Okay.
Thank you.
Thank you.
Can I ask?
Yeah, please.
Lennart, thanks a lot for the presentation. Actually, it's nice to see the vector correction model applied to this type of event. And I have a question. Which data do you use? Because you need a lot of data to have a stable and robust vector correction model, first of all. And I don't understand the specification that you use to actually estimate this model, because also take in consideration that the vector correction model actually study, as you mentioned, the long trend among variables, and then also the causality of them, is a very changing market. So we observe new NFTs every day. So really, for me, is a little bit more substantial. My question: does it make sense actually to use this vector error correction model to solve something that is not like inflation at the exchange rate, but something that is changing on daily basis? And that's why I'm asking actually which data did you use and how long is the time series?
Yes, so I use data from the site here, non-fungible.com, and it's
Yes.
it's daily data. So if we look here, so I have time series of about 1,428 days for the largest project, and for the smallest one, the ones that I actually had to drop, they were like 30 days or so. So I believe that for the older projects, the approach of the vector error correction model is quite suitable, but obviously there is explosive growth and exponential growth, and that may be some problem here for the model. But these markets exist for a very long time, and they only picked up attention this year. But for example, CryptoPunks was started in 2017, so the data is there.
Okay, Lennart.
And the idea to apply vector correction model in something that is changing a lot, what do you think? I mean, you only focus on sub-project, not on the entire market. So that's a little bit, puzzled.
Yes, it could also be an approach to use a time-weighted vector error correction model. It could be something to look at, yeah.
Okay, but anyhow, it was interesting.
Okay.
Dennis Kunschke, DLA Piper, may I quickly also ask a question? Can you hear me?
Yes,
Yeah.
yes. Just
Okay.
one last question.
I think one last remark. I think what would also be very interesting to measure for the example of Decentraland, it's selling NFTs, the pieces of land in itself, but there's also a community of protocol token called Mana, right? Yeah. And so what is the correlation between the NFT sales on chain and the community token? So let's say if the volumes go up, does the value of the of Mana go up at the same time? Because then there's an indication that from an economic, not legal, but merely economic perspective, many of the community or protocol tokens may actually be similar to a regular stock. But
yes, I think. Yes. So that's something that I list as future research in the article, but that's also something that an article of Michael Dowling in Finance Research Letters already did. So he is analyzing especially Decentraland and the currency Mana and land, and is looking at specifically this question, I think, more or less, but stuff like this is being done, yeah. So thanks for the comment.
Okay, are there any questions, other questions? So I think we are running quite late, so I will refrain from asking my question and just go on with the next session. Thank you, Lennart, and thank you for all the speakers of this session. Bye-bye.
So I will ask Francesca to join us. Francesca Mattasoglio from University of Milano Bicocca. She will be moderating the final stream of the conference, which will focus on legal and regulatory topics. And Francesca, the floor is yours.
Thank you. Thank you very much, Ferdinando, and welcome to this final session. First of all, I would like to thank our sponsor, the gold ones, Chexic and Deloitte, and the silver, Elidata. So I know that we are late, so I don't want to take time from the presentation, and I will immediately give the floor to the first paper, and in particular to Anna Maria Agresti and Dennis Kunschke, which present the first paper of this section entitled Non-Fungible Tokens, Legal and Economic Consideration, a European Perspective. So, Anna, are you here?
Yes.
Yes.
You can hear me, you can see me.
Yes,
Okay,
of
ciao,
course.
Francesca.
We come back to you with the topics of NFT. So the floor is yours. Thank you very much.
Okay. Thanks a lot. I think, Dennis, I can start the presentation. This is a joint work that I did when I worked at ECB, but I was for a period in this big law firm in Frankfurt, DLA Piper, where actually we developed together, we were working together on the NFT. That's why we end up to write this paper. This paper, just a first disclaimer, doesn't respect the view of the ECB and are strictly personal. Another thing that I want to say before going in the presentation, even though this paper is pretty extensive, so we try to put together all the most important issues, and some of them they already in the previous presentation they came up. We want to point in the paper the most important problem that might come up from all perspective, trading perspective, consumer perspective, protection, that actually we encountered in analysis of the NFTs. So it's a pretty an extensive analysis, even though it's not exhaustive, so there might be, and we already saw in the previous presentation, other aspects that needs to be addressed. After a brief introduction, and some of the information were already given in the previous presentation, I'm going to address which are the characteristics of the NFT. Then one crucial point are the intellectual property right, and Dennis is going to give a very deep overview about the problem related to the property right of the NFT, and then we go directly to the economic and valuation issues that are still very open to give as a final information a national perspective how the supervisory law try to address this issue of the NFTs. Of course, conclusions are at the end of this presentation. So let's go to the introduction. I don't want to repeat what was said at the beginning. We agree on the term what is a token. A token actually is a representation of an underlying asset that can be both digital and physical. This is very important. Tokens are a set of information that actually run and are recorded in a blockchain. What is important that NFT, and this is crucial, I repeat, Dennis is going to give a big insight on this point, and actually create also a problem in the valuation, in the type of valuation that we have to apply for the NFT. When we have an NFT, actually we only become a proof of entitlement of this underlying asset, but actually doesn't mean that we have a legal ownership of this asset. But I think that Dennis is going to give additional detail on that. Let's go on the characteristic of the NFT. So we can go to the following slide. We mentioned that NFT, non-fungible, are basically tokens that are not exchangeable, so they are transferable, but they are not exchangeable with other similar or equal token, which is totally different from a Bitcoin. Bitcoin is actually a fungible token because one Bitcoin is equal to another Bitcoin in value and in an asset. What is important at this point of the NFT, and we will see also how in terms of securitization or how to securitize an NFT, is basically the idea that we can fractionalize part of this NFT. In this case, even though not always is the case, we can assume and we can think that fractional of NFT can be actually fungible token. Now I leave it to you, Dennis.
Thank you so much, Anna. Now we're going to look at some of the intellectual property rights aspects, which instantaneously spring to mind when we look at something like CryptoPunks, this was mentioned today, or also this mega auction of the Beeple artworks. And what is intellectual property? We take Germany as an example jurisdiction, but this should be almost harmonized. Intellectual property rights bestow the owner of an intellectual work with rights to protect such work, i.e. from the use of any commercialization by third parties. So in the case of these, I would call them natively digital NFTs or digital to digital NFTs, so no physical representation in the first place in the real world. Of course, the original creator of the CryptoPunk is the holder of all these bundle of intellectual rights. And now the fact that these are tokenized, brought on chain, is in the first instance just a factual circumstance, i.e. that on-chain, where, for example, on the Hedera hashgraph, the very JPEG may be baked into the chain, and via the private key, someone has unique access, indisputable access, as signed off by the nodes on the chain, to this very digital item. As such, doesn't have any legal quality to it in the mere digital place is factual. So the question is, can it be construed that the original holder of the intellectual property rights, there was a silent agreement that something was conveyed, for example, that may be multiplied, you may copy it, or you may even alter the CryptoPunk. And I'm the regulatory lawyer, but I understand from my IP specialists at DLA that's not the case. So there must be an explicit agreement in the terms and conditions, or if you sell them OTC, also in the very transfer contract, which is quite surprising, because you think you buy that and you have a legally certain position. That's not the case. So the core takeaway at the level of the IP rights, highly legally uncertain what rights are conveyed. And this legal uncertainty goes on because if I look at the NFTs, and now we're like really more into the what I call in REM or real world to digital or digital to digital, both arises the questions: are they can they be classified within the existing European legal framework, which currently is MiFID, which defines financial instruments, and then if emanation is classified as a financial instrument, a phenomenon, then there's loads of legal consequences, authorization requirements for trading it, prospectus requirements, just an entire bundle. But it is fair to say that the true NFT, which is really unique and not fractionalized, is not in itself fungible, which is, however, a prerequisite for the MiFID definition of security, because the basic picture of the security, transferable security as a MiFID financial instrument, is really tradability, and also in the sense of fungibility on a capital market. Doesn't have that feature. Now the interesting thing is, do fractionalized NFTs have this quality? So for a fractionalized NFT could be where, for example, a real piece of land, there are certain participations are held by a trustee, and now there are several units sold off which have the same intrinsic economic features. That's fractionalized. Or in the digital space, you have a number of editions of CryptoPunks of the very same. I would say economically it doesn't matter whether or not you're having a different series number behind it, but it's basically the same. It could also be called semi-functional. But then again, these do not convey security-like rights like we know them originally, like in a stock or a bond, like an entitlement to receive any dividend or other payment from an issuer. So quite likely, depends on the very circumstances, but quite likely a bunch of the NFTs are not securities under European law, and also as transposed in the member states. Coming up is the MiCA, Markets and Crypto Assets Regulation. It has a very broad and fundamental definition of crypto assets, digital representation of value or rights, which may be transferred or stored electronically using distributed ledger technology or similar technology. And we hear through the grapevine that NFTs, that there may be some political decisions going on, and that they may be carved out or separate regime. I don't know, not able to speak on that. But the latest public version, which we see, I personally think, even because there's like a carve out for non-fungible instruments just from the so-called white paper requirement, but it doesn't answer, MiCA in itself doesn't answer the fundamental question if the natively digital NFTs in particular are originally in scope of the definition. And I personally have doubts, because from a legal perspective, I don't know what the representation of value is, because going into the future, maybe all real world phenomena and digital phenomena may just be tokenized. And so the question is, what is of value? If you have the tokenization of, I don't know, an art piece which no one likes, does that in itself have a value? And I think that was touched on earlier as well. So a lot to do on this front, a lot of questions to answer. But Anna, back to you on economic considerations and valuation.
Yes.
think we may have a bad line.
Yeah. If you can change the slide.
I did, Anna. I think we have a low bandwidth and you cannot see the slide.
Anna, are you here?
I think she has a low bandwidth.
So you have the floor.
Okay, Anna, if you come back, maybe we can clean that up. What I would, you can still see me changing the slides, right? Is that true?
Yes.
Okay. No, we can't see you, but we can hear you. Maybe Anna, maybe you can come back in later when your availability of data goes up. But let me just finish on the German regulatory side. We took Germany also as an example jurisdiction because we have over-implemented the anti-money laundering directive and also have something in place which looks similar to what MiCA will do in a couple of years, i.e. we introduced a unique German non-MiFID financial instrument, which is called crypto asset. And also here, I'm not too sure whether or not what I would call this natively digital NFT would be subject to this definition, because it must be represented. It must be a representation, at least a representation of value. I have an investment value. Does that and is just the acquisition and sale of goods? You know, this CryptoPunks, just this bunch of pixels. I buy them and sell them. Does this in itself have an intrinsic value in a sense of investment value, or does the regulation actually refer to something else, like a classical investment into something real, which is capable of generating a return in itself, and where's a fully functional market for it? So what's quite interesting that also under the German transposition, we don't have legal certainty, in particular on the purely digital NFTs. We also have a over transposition in Germany on non-MiFID financial instruments, which are illiquid, so shares in companies, trusts in particular. And here I also high legal uncertainty, but we have a certain tendency that what I would again call in REM or real to digital NFTs. So for example, for collectibles, physical collectibles, real estate, there must always be a trust component to it, which someone who holds the physical asset on behalf of the token holders, or there must be fractionalized in REM in entitlements, which oftentimes give a return on real world assets. That's usually how these are structured. So they have the tendency to fall under a specific German non-liquid financial instrument, but also that's uncertain and must be tested with the BaFin in each case. Anna, I don't know if your bandwidth is up and we can.
I'm back now, so we
You're
can
back?
go.
Yeah, you can.
Yes.
I finished, but what you can clean up economic considerations and valuation.
Yes. So far, the main message so far, I think that there are a lot of legal uncertainty in the classification of the NFT. Also, from economic point of view, we had some difficulties in classifying the NFT financial instrument or not. So let's start what the ECB approach has been on the crypto asset. And here you have the definition of the crypto asset as a new type of asset recorded in digital form and enabled by the use of cryptography that is not and does not represent, which is very important, a financial claim or a liability of any kind of entity. This is very important. It's very broad type of definition. They are not crypto asset. It was, I think, already mentioned by Dennis. They are not covered under the MiFID. But what is very important, since the definition is very wide, is very bright, we might consider NFT in this definition of the ECB. However, the same ECB in the task force and the national paper published in 2019 actually say hold the token are outside the scope of this classification. So also the definition of DCB, while it's very wide, doesn't seem to envisage to consider in this perimeter of crypto asset also the NFT. Let's go now on the second slide on the valuation. An additional, or I would say with my economic background, that the reflection of these uncertainties actually reflected in valuation. I was not able to find a very stable contribution on valuation. They go from rarity, scarcity, and is related to the underlying, mostly physical assets, so they are applied model of scarcity in this sense, or we can apply the user valuation model, and we saw some presentation in this respect. What I think the problem is now that even though more money, and the previous presentation shows that there are an increasing number of transactions in NFT, still remain a very poor liquid market. I would go now to the conclusion because it's late, it's the end of the week, and it's the end of the day. So what we said, and this was the part of that Dennis clarified, when we consider some fractionalized NFT, we might consider them and qualify them as securities. So also in the NFT, the main message I want to say, not only there is an uncertainty in classifying these entities, but also the type of NFT can be classified in different way. A second level of uncertainty is not clear, and also the European Commission is working on that. The national competent authorities are working on that. If the NFT default inside the perimeter of MiCA, there are many risks related to valuation, and especially because they are related to the intellectual property right. And I think the point was made clear at the beginning of the presentation and during the presentation. So the current legal framework does not address all the intellectual property issue. So in the NFT, that's why it's important in each transaction what it's about, because there is no understanding there. Insurance. Then the German perspective time be considered as an investment product, as Dennis clarified in this model. I don't know the point of this legal consideration and economic consideration. When we gave the uncertainty in which you are working.
Anna, sorry, but we can hear you very well. We have some problem with your connection. Try to speak again.
I think we finished. If I may finish that off, Anna, if you can hear me. And the core message is that there's, in particular in this asset class, however the rights are construed around them, and some of the NFTs give certain rights, that we have more certainty, but particularly in absence of any stipulations, it's very, very tough to classify them under any applicable European or national gold plating law. And that should be the core message of our presentation today.
So, thank you very much. And there is immediately a question for you from Ferdinando.
Yes, on the slides you say that the NFT is a proof of entitlement to the underlying asset. And in a way I was wondering, because basically I'm under the impression that there is no underlying asset at all. In a way the NFT is just an hash value pointing to some digital artifact, and as you clarified, there is no legal ownership over the underlying asset, but in a way one could challenge and say that there is no underlying asset at all, the NFT being the only asset being traded or exchanged. And so, I mean, I do understand that people still have problems with Bitcoin as the digital equivalent of gold. They say there is nothing behind Bitcoin, but there is nothing behind an NFT too. It's like it's pointing to something existing in the real world, but has no relation in a way, not ownership. So how do you say that there is an underlying asset?
You know, we just generically refer to that. So for example, if you have this collectible and NFTs, I don't know, Rolex watches. But then in my thinking, my terminology, the underlying asset is the asset being tokenized. So it's this physical emanation in the world, in the what I call digital to digital NFTs. So the CryptoPunks, you still have the, let's say, the cryptographics as such on chain, and they point to something that can be made visible. So that my understanding there would be, but maybe that's you can also call it, there is no real underlying. I'm fully fine with that, but it makes it easier to graph it. So my thinking, the code is one thing, and then the private key gives an entitlement to make visible this picture of the CryptoPunk, and that's underlying the chain information. If that even makes sense. If you have a better terminology, all of this is developing. Totally fine to be convinced to the contrary.
I don't know if you hear me. Can you hear me?
Yes, now, yes.
Yes, I think it's a very good question. We have been discussing a lot about it. Sometimes when we had the other presentation, actually when they explain the NFT, they explain that they keep something in a vault, in a magazine, in somewhere, and they have a digital representation of that. But it's more than a valid question that we have been struggling to solve. So it's another layer of uncertainty on the other uncertainty that we wanted to point out in this presentation. The perimeter of MiCA is not clear, the intellectual property rights are not clear, and even, as you mentioned, the underlying asset maybe is not there. It's a very good point.
So thank you very much. Anna Maria, are there any more questions? No. So yes, thank you very much to Anne and Dennis. And now we can move to the second paper of this legal session, presented by Riccardo de Caria. Riccardo presented a paper entitled The Impact of Tokenization on Property Law. Riccardo, are you here?
Yeah. Yes.
Oh,
yeah.
We can hear you.
Can you hear me?
Yes.
Yeah, that's great.
The floor is yours.
Thank you. Jessica, it's a great pleasure to be here. It's becoming an annual event that cannot be missed in this field. I'm very glad to be a part of it. Let's start with this very difficult subject. So the impact and the application and legal issues raised by tokenization in the field of property law. So apparently tokenization here is offering, at least according to some views, some new solutions to some old property problems. We'll see that in more details in a moment, but we can summarize the main advantages in terms of added security, more legal certainty, higher speed in the circulation of goods, and lower transaction costs. So overall, these are the benefits that can be achieved through the tokenization of assets. First of all, I'd like to point your attention to the fact that there's two layers of property when we look at the tokenization of assets. So there's first of all, there's the tokenization implies some dominion, some form of ownership, of control over assets. And these assets are mediated, obviously, by some digital instrument that represent a property right. So these are the digital assets. So we have two assets, two forms of assets. So there's two layers, two levels of property as well. So the one preliminary question that needs to be asked, and that's not so straightforward to answer, is whether digital assets, so the second one, the latter, in my list, but the first, in logical terms, whether they can be the subject of property rights. It's, as I said, it's not straightforward. It's not so easy to answer this question, and I don't have much time to get into the details of it. So I just leave it out there. But it's definitely something that influences the whole analysis of tokenization of property rights. because also in light of the fact that there's no currently definition, a common shared definition and legal framework for the whole category of digital assets, as was mentioned earlier. So this is what makes my task here particularly difficult. But anyway, also in general terms, what we're considering here, and I'm trying to clarify what I'm not discussing here, is we're covering non-financial tokens, so tokens that cannot be equated to securities, but this is in terms of their economic function, if you want. If we then look at traditional categories, or at least more commonly used categories, even though we don't have also this taxonomy, sufficiently established taxonomy yet, but still we do have categories under which we categorize tokens. And with the tokens I am considering, so we can call them non-financial tokens, they cross different categories, they cut them through. So non-financial tokens can be both physical and natively digital. They can be both fungible and non-fungible, and they can be both utility and security tokens. Obviously here the issue is whether there's an investment purpose or not, but the point is we're not just discussing NFTs or fungible tokens, we're not just discussing utilities or security tokens. It's something that cuts through the main areas, the main categories that we have so far identified in the scholarship. So anyway, I propose to move forward by looking at the traditional categories of goods, in fact, of assets, at least the ones I'm most familiar with in my own jurisdiction. So I'd start by considering movable assets. And by movable assets here, I'm referring to physical goods that have some corporal nature and some corporeity. They have this physical feature, and I'm leaving aside immovable properties or otherwise registered property like cars or boats. So this is what I'm talking about here. Typically, this is what happens. This is what we have in the so-called digital twin operations. Operations that allow the transfer of an asset through the transfer of the token, which is something that is not entirely new. Obviously, this is something that the law has had to cope with for quite some time, because it reminds us all of the traditional process of securitization, even though obviously in a dematerialized form. So the legal issue here is whether the transfer of a token from wallet A to wallet B implies a transfer of property. And here we have different legal systems. We need to do a little bit of comparative law here, because we have some so-called exchange of consent systems. So systems whereby it's enough for the parties to exchange their consent in order for the property to be legally transferred. And that's easier, obviously. But we also have legal systems where you need the delivery as an essential element of the transfer of property. And sometimes in some jurisdictions, you also need a valid title, which makes things a little bit even more difficult. But anyway, in the scholarship that has been developing in the field, I think the consensus is that the transfer of a token within the context of a smart contract can be characterized, can trigger, can meet the requirement of delivery of the good, be it in the form of a true delivery or a symbolic delivery, like traditio ficta in Roman law terms. But still, there seems to be a consensus that that transferring a token can be enough to meet the requirement of the delivery, even in these jurisdictions. Moving on with movable assets, the point is that what happens with tokenization here is that the person who has a token in his or her wallet is legally entitled to obtain the availability, so the physical possession of the asset that is represented by this token. The problem, though, I mean, this is quite straightforward. The problems start to raise when to be raised, but when there's when we appreciate the dichotomy between off-chain and on-chain word, meaning that sometimes the fact cannot correspond to the law, and so we need to ask ourselves what happens here. It can be that I'm the legal owner of a certain good according to the smart contract and to the token, but I'm not in possession of this good because this good is currently under the possession of some other person. So there's a disconnection between on-chain and off-chain. And on the other way around, you could have the title that is invalid. This is an upstream problem. So I might be the owner according to the registries, but there might be some problem with the title that is declaring me as the legal owner. So in both cases, I believe that ordinary remedies can be implemented. It's possible to go to court and to fix this dichotomy and to let the fact coincide with the law. The thing is, obviously, courts will need to rely on experts, which is not necessarily easy. There's problems of interpretation of smart contracts and so on and so forth. And then there's also the problem, obviously, that has been investigated by several scholars about the fact that smart contracts are obviously self-executing, so it might be difficult to enforce a court ruling invalidating a smart contract, but that's another subject. Finally, some words on joint ownership, because here we come across some very interesting business perspective, but also inevitably some legal conundra. I mean, we're faced with some legal difficulties. We can have situation of joint ownership in the first set of cases, which are the easiest ones. So assets that are already co-owned in the real world, in the off-chain world. What happens when we want to tokenize these assets or anyway transfer an assets to multiple people, and so to establish a co-ownership through tokenization. So apparently the possibility to use multi-signature wallets would let us solve this need for co-ownership of an originally single-owned asset. What's more interesting and more promising is what happens with the fragmentation of assets. So when you have a multitude of people acquiring a multitude of tokens, which is obviously very easy to do thanks to the fact that Bitcoin can be divided up to the eighth decimal digit. This is done in order to let these tokens circulate on secondary markets. And it's promising because it's much more efficient than traditional methods. Obviously, there are some legal issues. For instance, under traditional legal regimes, at least under civil law jurisdictions, co-owners have certain burdens and responsibilities. They also can request judicial division at any time, which is very cumbersome if applied to tokenized goods. So the question here would be whether these rights can be limited by a clause in a smart contract. It's an open question. I don't have an answer yet. A technical solution, a practical business solution can be to use an SPV, a special purpose vehicle, to be the sole owner of the asset and then tokenize the shares and fragment the shares. But that's no longer an actual co-ownership, a tokenization of a co-owned good. Moving forward to immovable assets, and I'm getting close to the end of my presentation. I think I'm right on time. We've got many advantages here. Some of them I have outlined them already. Let's just list them again. We have lower costs because if you tokenize immovable assets, you do that by you are able to get rid of intermediaries, so you cut through the middleman, and so therefore you obviously have lower costs. You can achieve more liquidity in many markets because you have many more opportunities for investments, because you given that you have lower transaction costs, you have many more opportunities to invest, because it doesn't become you don't need to have a large investment in order to offset transaction costs. So it means there's many more people who can invest. And this is also leads from a policy perspective to a democratization of investment opportunities. Tokenization of real estate can also let you tokenize only a fraction maybe of some property, which leads to a lower immobilization of wealth. In traditional terms, you need to put your house as a collateral, your whole property. Instead, here you can only use a fraction of your property as collateral, which leads to a decreased immobilization of wealth, which is obviously beneficial in general terms. Basically, everything I said about movable assets can be applied here. The thing is, we have further questions here, but the ones that I described earlier are still valid. The obvious problem here is the fact that in order to transfer real estate, movable assets, typically in many jurisdictions, particularly civil law jurisdictions, you need some third-party intervention, which is typically takes the form of notarization by notaries public. It's something that's quite straightforward and it's apparently unsurmountable. And for instance, if you look at Liechtenstein law, they haven't regulated tokenization of real estate, not by coincidence. The point is, there's also further problems connected to this, because these traditional official state licensed intermediaries typically are the ones who are in charge of controlling the identities of the parties, of validating the contract under which the circulation happens. There's also problems related to co-ownership with regard to immovable assets that are come up here again. And there's obviously the problem when you identify the invalidity of a transaction. That's really technically there's this problem of impossibility of amending the register. The problem is, apparently you cannot get rid of. Either we envisage a radical change in the existing regime of property circulation, or we end up contradicting ourselves, for instance, by considering the use of permissioned blockchains, which has been done in many projects, but I think it's quite contradictory with the original idea of this intermediation and of getting rid of the middleman. Final category, immaterial assets, so no corporality, so not physical goods. So here we have both the token and the represented good that are immaterial. We can identify two subcategories. We can have so-called reified rights, so intellectual and industrial property rights. Here also we have the advantages that we have identified earlier, so more security, more certainty, can guarantee uniqueness, you can have a reliable register, also you can use a timestamp for the management of copyright. You have similar problems to the ones that we described about immovable property, even though they appear less insurmountable, because and in fact the monopoly of collecting society has been partially overcome already, aside from tokenization. It's also interesting the possibility for authors to tokenize their copyright and exploit it from an economic perspective. And then you have the second subcategory of natively digital goods, so the so-called digital arts. And so here you have the use of NFTs to represent, in this case, natively digital goods. They have been very well covered by the previous presentation. I'm just gonna raise a question whether these digital objects are
Riccardo,
subject to property. Yes?
I'm very sorry, but we are late.
Yeah.
You have to go to your conclusion. I'm very sorry.
Towards the end, I mean, it's 15 minutes now, I guess. So I'm close to the end. So there's a question whether NFTs are personal property, according to some authors, or whether NFTs do not embody property rights. I'm right at the end. There's more and more economic sectors involved by tokenization of assets. Tokenization has impacted on many fields of the law, but and that have been already investigated a lot. I think the impact on property laws here requires much investigations. I think moving forward with the traditional categories is the best way to go. So movable, easiest to do. Tokenization is easy to do from a legal perspective. Immovable, most difficult. Immaterial, it's intermediate level of difficulty. It will remain to be seen whether, and I'm finishing my presentation, whether the anti-governmental momentum will be maintained or whether the contradictions that I was outlining earlier will prevail, and therefore in some way this whole breakthrough technology will be normalized, if you want. It will be interesting to see. So grab the popcorns and thank you very much for your attention.
Thank you very much, Riccardo, and sorry again, but we have immediately to move to our final presentation. Thank you very much. And now, our last paper. The title of the paper is Towards Total Decentralization Through Non-Adjudicative Methods. Is presented by Giulio Stefano Ravot, and the other one is just your colleague. Because the paper has 4 different authors. Cristina Poncibò, and I suppose that Cristina probably is here.
Yes.
Is online.
Yes,
with
I'm
us.
here.
Oh, hi, Cristina. Nice to hear
Hi,
you.
nice to see you all. Hi.
And the paper is also the product of the work of Andrea Canidio and Giacomo Corrias. So I will give the floor immediately to Giulio Stefano, and the floor is yours.
Sorry. First of all, I would like to thank the organizers. It's honestly an honor join such a high-level panelist. I'm also grateful to Professor Cristina Poncibò for supervising our research work. As far as the title of the speech is concerned, namely, Towards Total Decentralization Through Non-Adjudicative Methods, I would like to suggest an idea, a different way to see how we could handle smart contract disputes with a better fit with the principles, values, beliefs of the blockchain. For doing so, I'm glad to present Asper Anonymous Dispute Resolution, a blockchain startup which provides a 3-step mediation process. The message that we want to spread is about a process in which users can solve conflict between them without intermediaries, lawyers, judges, and more generally any trusted third parties, TTP. Just for have an understanding of the background, let's suppose to have a smart contract representing the contractual terms of a freelance service. When Tizio sends an amount of crypto to the smart contract, it automatically releases the links to access Caio's website, and until now the functioning is optimal, but what if Tizio, after having paid, doesn't like the work? This conflict can be solved in the court. We are in a lawless land. Traditional litigation fails since it's not able to preserve anonymity, so this gray zone of the law have been filled up by a number of private companies that, like us, operate with smart contract disputes. However, like us, they use TTPs. They use anonymous arbiters deciding what is right and what is wrong. Well, in the following slides, I will argue that this is not the best way for dealing with conflict in this specific environment, since an arbiter does not reflect the blockchain ideology of an independence movement distancing from the central authority day by day. For support this strong statement, I would like to start with a comparison. We are all aware that the database is a centralized system while the blockchain is a decentralized system. The same comparison could be made with the two most commonly used ADR tools, arbitration and mediation. An arbiter is clearly a centralized system. An arbiter taking a binding decision on the dispute is as close as one can get to the idea of a third-party enemy of this world. On the other hand, mediation is a decentralized system, is something more peer-to-peer, is something more blockchain-friendly, since it leaves to the litigants total control over the outcome. And this is a key feature in this new era. Szabo, in Trusted Third Parties Are Security Hall, started what could be called a counterculture, an independence movement. Blockchainers are closing themselves. They do not want to delegate decision-making, validation, control power to anyone else. So, if a user makes a transaction in the blockchain because he wants to avoid the control of an hypothetical third party such a bank, he will probably not want in the same transaction again another third party taking a binding decision, but will rather prefer a decentralized process in which can keep total control over the outcome by choosing if, when, and how mediate these disputes without the need of anyone else. The blockchain is not just a technology, but a socio-technical system. So all these social aspects should have a high value while choosing the right dispute resolution model. I'm aware that this could look just as an abstract sophism, but I would like to bring to the table a concrete example coming directly from blockchainers that perfectly embody this need of autonomy, control, risk management over transaction. This is a quite recent tweet from the former CTO of Coinbase. He says that if you can exit at any time, you might be more willing to delegate control on a daily basis to a centralized actor. Trust because you don't have to trust. And this is actually the core of mediation. With mediation, you can literally exit at any time. You might trust the mediator because you don't have to trust him. Because even if it's a third party, it's a decentralized third party that will never be a security hole for the transaction of the users, since it will never have decision-making power. So in this sense, this looks to be a much more blockchain-friendly tool. We can start to see an idea of mediation as a way to escape from tyranny. Again, the same author, speaking about conflicts in the social networks, suggests a different model in which the lowest common ancestor mediates. So, just as an example, in this case, in this graph, if there is a conflict between node 9 and node 11, and node 2 will be the mediator. So we can see again an idea of solving conflict within the ecosystem, on-chain, without relying on third party, and we can see again this idea of mediation as a way to escape, in this case, from arbitrary deplatforming. So, with the right effort in promoting mediation, in the same way legislatures are currently doing since years off-chain, will be probably the users themselves to prefer a TTP-free model rather than an arbiter, which is a third party, which we already know they do not trust, and however, they will never have found themselves in the blockchain. So I do really believe it's just about make them aware. Kleros, Aragon, and Jur are the main arbitration provider in the blockchain market. Even if a third party will always be needed to maintain the rule of law, an arbiter will always be needed to maintain the rule of law, there are many reasons to argue that mediation should have a priority over arbitration, not only from an ideological point, as mentioned before, but also from a concrete practical perspective. More specifically, the existing literature, the existing academic literature, have been highly critical, referring to the way some companies actually make arbitration on-chain. They actually use a form of on-chain incentivation voting system based on game theory, more specifically based on the Scharnowski point, which allow cooperation without communication. So just as an example, image to user in front of a panel with 4 squares, 3 blue and 1 red. They both win a prize if and only if they select the same square, but they cannot communicate. So reasonably, they will select the red one. This is not a better square than others. It's just a square that, in a sense, stands out. Well, the same logic was taken up by Kleros and other company and used for dispute resolution purposes. So if you want to become an arbiter, you need to stake an amount of token. Then the selected arbiter will make their decision, and at the end, those who voted for the most proposed solution will receive a token in return.
while the arbiters that did not decide uniformly, so did not take the same decision as others, are penalized. This procedure could evolve in new forms of decentralized security halls, even more dangerous than the centralized system from which everybody ran away. The first security hall is concerning the quality standards. As I said, anybody can be an arbiter. You just need to stake an amount of money, an amount of token. In this sense, words of Professor Emmert are well representative. What is the relevance of such a vote, one may ask? The second decentralized security hall is about the decision maker. He's selfish. He's merely interested in not losing the stake he made. He only thinks about how the other juror will make their decision, so he does not care about the well-being of the litigants. So these bring us far away from the right legal result. Also, this system could evolve in a form of first impression voting system in all the cases that are not worth any real effort, so all the conflicts that are economically unattractive. Also, I would like to open a consideration about one of the main elements of justice and also decentralized justice intended to be ethicality, namely the ability of a system to be perceived fair by the community, and this seems to be a major concern in decentralized justice. The third decentralized security hall is about the fact that we have an incomplete judgment, so there are no discovery compulsion mechanisms. The arbiter will have only two types of evidence. On the one hand, elements in the favor of the party submitting the material. On the other hand, elements against the other party. So we are missing a third source of information. All the evidence that inflicts self-harm is missing. So the risk to meet an arbiter, this is incompetent, this is only economically oriented, and that can make a decision that is incomplete, can make decentralized justice pretty dangerous. Also, I would like to open a cultural reflection about these new ways of incentivation voting system. More specifically, Professor Mexer pointed out that there are economic barriers to enter. As I said, you need to stake an amount of token, but this amount of token is pretty important. At the time of his writing was 600 Australian dollars, which is much more than the average monthly salaries in all the countries which blockchain is actually more used, Africa, South America. So it seems that decentralized justice risks to becoming an oligarchy of white, rich millennials from advanced countries, and this could be even more unpleasant than the central authority from which they instinctively flee. Our solution, but not only our solution, any form of mediation, any form of non-adjudicative methods, gloss over all these problems, simply because there is not a decision maker. So, coming back to the example said before, if Tizio doesn't like the website, he can activate the clause, Aspera clause, by clicking our website, aspera.rocks. After an initial stage of capital freeze, chatbots will contact the litigants asking them a number of questions. Why you did not like the website? How we can find a solution to this problem? So in this way, we will have a number of conflict data that will be organized in different data sets according to the type of dispute. This data set will be used by machine learning to provide a mediation proposal. If the agreements made by artificial intelligence are not accepted by the litigants, it will be possible to assess the Aspera virtual camera for anonymous mediation, in which it will be possible to mediate the dispute in live, face-to-face with a professional mediator, but in complete anonymity, since through live deepfakes we will change the face, the physiognomy, and the voice of the users, make them unrecognizable. In conclusion, it's necessary to underline that mediation is not the panacea for all conflicts. It's not always possible to find a peaceful solution to the problems. This is why we have a phase 4 with arbitration, but we really hope will be perceived by blockchainers as an extrema ratio, and that the mediation could be the new independent way for solve conflict on-chain. Thank you for your time and attention. I will be happy with Andrea to provide any further information if necessary. Thank you again.
Thank you, Giulio. And now, just Cristina, do you want to add something to this presentation? Just in a few minutes.
Thank you very Okay, can you hear me?
Yeah.
Can you hear me? Okay. Thank you very much indeed. I know we run out of time, so I need to be very short. The question is obviously to find the remedies and mechanisms that are suitable for the blockchain reality. And indeed, this is an important discussion if you like that the blockchain is more often used by ordinary people and it becomes a shared technology more and more. There are many possible options in between arbitration, mediation, reliance to the courts. I think that it is reasonable to expect that online ADR and the dispute resolution mechanism will be very relevant in the digital world because of many different reasons. So we are exploring decentralized justice. What is the point that my colleagues they have raised that is academic in its idea is the fact that we have to take care that this decentralized justice is fair in the sense that we may not accept the idea that you can be a judge if you pay for. This is my point. This is what I think, honestly. There are many possible options that may work, but it is important that some fairness from the old world may reach the new brave world of the blockchain. And this is a point that this presentation raises. And I think mediation, after discussing with my colleagues, I got impressed by the potentialities of mediation because, for example, in mediation you have a mediator who is facilitating the solution of a dispute. Now, it's just, we used to say as lawyers that the mediator is a facilitator, it's not a judge. So he or she has not to say you are right, you are wrong according to a law that you have to qualify, that you have to find in the and to solve the issue of conflict of laws and jurisdictions. So it's not to say you're right, you're wrong according to a law, but to facilitate the parties to reconsider their positions on the chain and to find some sort of agreement. So if you think in this term, you may avoid a number of issues. And this is my point.
Thank you, Cristina. There is a question from Ferdinando for you and for your colleagues.
It's more of a consideration. I mean, most of the Bitcoin protocol is about the arbitration in the case of double spending of which transaction is the valid one and which one is to be considered invalid. And if you think about that, the solution, which is by arbitration, and which is not by mediation, and I find it very problematic or unlikely that could be solved by mediation, costs a lot of energy. You know, everybody's aware of the mining issues, and so in a way, we are still trying to establish that as a sustainable protocol. Probably it is, but to go to broader or more sophisticated blockchain and smart contract, of course, open these problems, like how do we solve them? Do you think that this might be solvable without energy? Because, you know, arbitration in a way is the way of trying to have the less energy involved into finalizing a context between two alternatives. Mediation can be much more consuming than the arbitration way that we have seen on the Bitcoin blockchain protocol.
Well, as far as the consuming of the arbiter, I think the concept of decentralized justice is actually more consuming since
they need to move a lot of people for this kind of justice. In our system, since we avoid the third party, it can be so less consuming since there is not a human element in the conflict resolution process. So if the users are able to reach an agreement through technology without human involved, not even decentralized human, then will be less consuming than any other third party, such a human arbiter involved in the transaction. Because in this sense, the peace is made only by the two litigants and the technology. In arbitration, will never be like that.
Thank you. So the time has come to close the conference. Thank you, Francesca, for managing the last stream. Thank you to all the presenters, to all the moderators and to all the organizers. And of course, to go without saying that we have to thank also the sponsors, Deloitte and Chaksig and Elidata, but the University of Milano Bicocca for being such a kind and generous host and organizer, and the European Commission, namely the DG JRC, Joint Research Center, and the Digital Gold Institute. So thank you, everybody. And of course, let's look forward. I hope you will join me in looking forward to the conference next year. We will announce the call for paper by the end of this year, so to have probably the next edition at the end of September or around those dates. So stay tuned. Thank you very much, and see you down the road. Bye. Thank you.
Thank you. Thank you. Bye.
Thank you, Cristina. Bye, Anne.
Thank you.
Bye.
Bye.
Bye. Bye.